Good morning, everyone. I'm Brian Smith, the Deputy Assistant Secretary for Federal Finance at Treasury, and welcome to the 2024 U.S. Treasury Market Conference. This is the 10th anniversary of this conference, co-sponsored by the relevant authorities in the U.S. Treasury market, the Treasury, the Federal Reserve Board, the SEC, the CFTC, and the New York Fed. Over the past decade, this conference has served as an invaluable forum for collaboration across the official sector, the private sector, and academia to support the health of the U.S. Treasury market. Today, we're delighted to have several speeches lined up from senior officials across the joint member agencies, including Treasury Secretary Janet Yellen, Federal Reserve Chair Jerome Powell, New York Fed President John Williams, Vice Chair for Supervision Michael Barr, SEC Chair Gary Gensler, and CFTC Chairman Russ Benham. We also have three panel discussions with industry leaders, academics, and members of the official sector. Those panels will be moderated by Scott Mixon, the acting chief economist at the CFTC, Michelle Neal, head of the markets group at the New York Fed, and Josh Frost, acting assistant secretary for financial markets at Treasury. These panels will cover a broad range of topics, including the use of futures in the Treasury market, recent developments in central clearing for U.S. Treasuries, and the evolution of Treasury market structure. I'll now turn it over to Brett Rose, with whom I'll be sharing today's MC duties.
Thanks, Brian. Hi, I'm Brett Rose. I'm the director of the Treasury and Mortgage Markets Directorate here at the New York Fed's Markets Desk. It's a pleasure to be joining everybody here again for our 10th annual conference, and I'm really looking forward to these events and hoping that everybody, gets into a lively set of discussions. Brian highlighted the agenda and the people that will be up here on stage. But I'd also like to acknowledge the tremendous set of attendees that we always get at this conference, which helps make for lively discussions during our breaks. And given that, I'll go over some of the logistics for the day, and then we can get started with our content. First, we'd like to remind everybody that today's conference is being live streamed to the public via webcast on the New York Fed's public website. And recordings will be posted to our website soon after the conference. I'll also note that we have members of the press here, and therefore any remarks made during the day will be considered on the record unless otherwise noted. We'll also be opening up the audience to audience Q&A at various points during the day, and we will cue people when those are happening. And when we do that, we ask that people raise their hands, and somebody will bring a mic around to you. And please introduce yourself with your name and the institution you represent before you ask your question. And we'd really like to encourage audience Q&A. However, only conference attendees will be able to ask questions, not viewers on the public webcast. Similarly, we're going to have three poll questions after each of the three panels, one poll question each after each of the three panels. And these polls will be conducted using your phones. So when we get to that time, we'll show a QR code on the screen, and that will take you to the response page. These polls are anonymous and are meant to be a way for the audience to participate in the discussion here today. In terms of other logistics, we have copies of today's agenda and a bio book of the speakers and panelists just outside the conference center where you came in. There's also a coat check just outside the door where you came in if you want to leave coats or bags there. But please make sure you get everything before heading down to the reception, which will be down on the first floor. And speaking of first floor, both the luncheon and the reception will be in the Liberty Room dining room on the first floor where you first checked in this morning. And we have two scheduled breaks that will be just right outside of the auditorium here. Also, there are conference support staff here to help if you have any other questions. And you can see people with the special staff badges here. Probably not speaker badges. They wouldn't be as helpful. So without any further ado, it's my pleasure to kick off the conference with pre-recorded remarks from FOMC Chair Powell. Jerome Powell first took office as the chair of the Board of Governors of the Federal Reserve System in 2018. In that role, Mr. Powell also serves as the chair of the Federal Open Market Committee. Mr. Powell has served as a member of the Federal Reserve Board of Governors since 2012. And prior to his work at the Federal Reserve, Mr. Powell has held a number of roles in public and private sectors, including Undersecretary for Domestic Finance at the Treasury. I ask you now to turn your attention to this video from Chair Powell.
Hello, everyone, and welcome to the 10th Annual U.S. Treasury Market Conference. 10th Annual is a phrase that generates a bit of surprise and much pride. It is surprising because it does not seem like the first of these gatherings, which I was honored to play a role in organizing, was all that long ago. But we can also take pride because the conference has proven useful and important for a full decade, as I expect it will do for many more years to come. Much has changed in the economy since we first gathered in 2015, but the importance of the U.S. Treasury market has not. As you all know, this market is the deepest and most liquid in the world. In addition to meeting the financing needs of the federal government, it plays a critical role in the implementation of monetary policy. It is no exaggeration to say that the Treasury market is part of the bedrock of our economy and indeed of the world economy. The October 14 flash crash and the subsequent publication of the Interagency Working Group report on that event are what brought us together for the first annual conference. October 2014 was a wake-up call because there had never been such a large swing in Treasury prices in such a short period of time. The Interagency Working Group report shed light on how much the structure of the Treasury market had changed and how large a role high-speed electronic trading firms were playing in it. It also showed the value of cooperation and communication between the 5 agencies in the working group, something that proved again to be vital during the disruptions caused by the COVID-19 pandemic. I'm pleased to see that all working group members are represented here today. You will be hearing directly from many senior leaders, including your host, President Williams, Vice Chair Barr, and Secretary Yellen, who of course was Fed Chair at the time of the first conference. It is essential that our Treasury markets are able to efficiently transform Treasury securities into cash, even at times of elevated stress. As I noted at this event in 2015, these markets need to keep functioning at a high level, and we all have a stake in making sure that they do. I remained wholly dedicated to that goal. I wish you a productive and educational conference. Thank you.
Thank you to Chair Powell for those remarks. It's now my pleasure to introduce John Williams. He's the President and CEO of the Federal Reserve Bank of New York, a position he's held since 2018. And as part of that role, he also serves as Vice Chair and permanent voting member of the FOMC. Before joining the New York Fed, he was President and CEO of the San Francisco Fed since 2011, and prior to that, their research director. President Williams began his career as an economist at the Federal Reserve's Board of Governors. He also served as a senior economist in the White House Council of Economic Advisors and a lecturer at Stanford. So please join me in welcoming President Williams.
Well, welcome everyone, and thank you for joining us today. And a special thank you to all those who make today's event so powerful, the distinguished speakers, the panelists, and the event organizers. So we have a packed agenda, and I'm excited to see what's to come on a variety of important topics. I look forward to hearing about the progress that we've made and some of the priorities we have for the future. So, as we heard from Chair Powell, today marks our 10th annual U.S. Treasury Market Conference. I think I may be the 4th person who said that. I'm guessing I won't be the last. It represents a decade of partnership between our agencies. These conferences have proven to be a valuable forum to share insights and perspectives on the evolution of the Treasury market, identify challenges and risks to smooth market functioning, and most importantly, discuss ways to enhance its resilience and effectiveness in both good times and bad times. The New York Fed is proud to host the conference each year. It leverages, I realize that leverage is actually not a good word for this crowd. So, shall I say it draws upon our strength as a convener of market participants, academics, policymakers, and central bankers. Today I'll take a look at how our interagency collaboration has strengthened our understanding of Treasury market resiliency and that of adjacent markets. And I'll talk about the importance of continuing this work over the next decade and beyond. I'll also share some news about our ongoing commitment to ensuring their financial system continues to stand on a strong foundation of sound reference rates. I got to give the standard Fed disclaimer. The views I express are my own and do not necessarily reflect the views of the Federal Open Market Committee or anyone else in the Federal Reserve System. So let's think back to the middle of October 2014 when U.S. Treasury yields plunged and then quickly rebounded, an episode later named the Flash Rally. This episode was an impetus for the drafting of the Joint Staff Report that ultimately led to the inaugural U.S. Treasury Market Conference in 2015. That conference first brought together what is now known as the Joint Member Agencies to discuss the evolving structure of the Treasury market. Going back in time, that meeting focused on the potential operational risks, the regulatory requirements, and considerations around repo markets. It drew about 300 people in our first conference. That's an impressive figure for our first year. And I know that some of you who participated in that conference are here again today. The organizers recognized that it would be important to have a regular forum to address developments in the Treasury market and the adjacent markets in order to continue to study structural issues and explore ongoing developments as a way to prevent disruptions in the system. Now, to be clear, attention on the function of the Treasury market didn't start in 2015. In fact, if you read Fed history, this is one of my favorite activities, it's clear that the importance of Treasury market functioning has been central to the Federal Reserve and here at the New York Fed for a very long time. But what became apparent in more recent times was that as the markets evolved, the need for formal joint agency collaboration and engagement with the private sector became more pressing. So what drives all of our efforts, from the staff reports to conferences to actions, and all the communications in between, is that liquid and well-functioning markets for Treasury and related securities are absolutely essential for credit to flow and the economy to prosper. It's not an overstatement that a well-functioning U.S. Treasury market is critical to our economy and, in fact, to the entire world. So what are some of the themes we've discussed at these conferences and what's been the impact on our financial system? So if you look back at the original joint staff report, it really highlighted two notable issues. First, that principal trading firms played a much larger role in the electronic trading market than was previously understood. And second, the need for improved transparency and increased availability of Treasury market data. 10 years gone, the song remains the same. Those themes are still at the forefront of our conversations. For example, while principal trading firms still continue to be a big presence in the market, hedge funds now play an increasingly important role. And the work monitoring the changing investor base and participant types continues through this forum, and the work of the Interagency Working Group on Treasury Market Surveillance and the Financial Stability Oversight Council. And I don't know if you're noticing, I have not used an acronym yet. We'll see. I think there's some coming. Okay. On the data side, we've made tremendous progress towards increased data transparency with the Trade Reporting and Compliance Engine Data Initiative, commonly called TRACE. And while we've seen efforts to further increase the transparency, of this data to the public, March of this year, TRACE began publishing daily transaction data on the on-the-run securities at the end of each day. In fact, at this very podium last year, I said that we must continue to prioritize transparency and clarity in financial data, especially we look ahead to the age of AI, where the sources of data will be harder and harder to ascertain. I'd be remiss if I did not mention expanded central clearing as another key theme that's emerged over the years. It's a major shift. There's an outgrowth of our work, and we'll hear more about that in a panel discussion later today. And I look forward to the continued progress the market will make on this front as we move toward the implementation deadlines of the SEC's clearing rule. Okay, so before I cede the stage, I'll end on a topic that's at the core of the financial system, very closely connected to the Treasury market, and that's reference rates. Thankfully, we've said good riddance to LIBOR, and our financial system is now resting on a safe and solid foundation. Now, I know for those who were here last year that I promised I would not mention LIBOR ever again in this forum. Okay, but the LIBOR saga taught us all two important lessons. First, enormous systemic risk can build in the global financial system gradually over time. And second, it took a complex, expensive, decade-long effort to fix that problem. And we must not repeat that experience. So to that end, I'm pleased to announce that today the Federal Reserve Bank of New York is launching the Reference Rate Use Committee. It will convene private market participants to support the integrity, efficiency, and resiliency in the use of interest rate benchmarks or reference rates across financial markets. And that includes the rates published here at the New York Fed. Its first meeting will occur next month in October. The committee will focus on key issues regarding reference rates, including how their use is evolving and how the markets underpinning them change over time. It will promote best practices related to the use of reference rates, including the recommendations set out by the Alternative Reference Rates Committee, or ARC, during the transition away from LIBOR. In this way, it will serve as an essential partnership that builds upon the work and accomplishments of the ARC by helping to preserve a robust system of reference rates. This will complement international efforts at the Bank for International Settlements and the Financial Stability Board to monitor developments in the use of interest rate benchmarks and ensure that we never again have to face a problem like LIBOR. So I'll bring it on home. We're now on that bridge to the next 10 years of the U.S. Treasury Market Conference. Although there's been significant progress, the growth and evolution of this market remind us of the importance of staying focused on this work and continuing to make progress in the years ahead. In an era of heightened uncertainty and volatility, it's essential that the U.S. Treasury market remain liquid and resilient so that all financial markets can operate effectively. If you are ever in doubt how important this work is, the experience of the past several years should convince you otherwise. Thank you, and I look forward to today's conference and to another decade of partnership and success.
Thank you, President Williams, for those remarks. At this time, we're going to jump into our first panel, which will focus on the use of Treasury futures by asset managers. We'll reserve some time at the end of this panel for Q&A from the audience, so you can get your questions ready. I'll be handing the discussion over to Scott Mixon, who will be moderating the panel. Dr. Mixon is the acting chief economist at the CFTC. His work focuses on economic and econometric analysis of derivatives markets, as well as directing research activities of the Commission in connection with rulemaking and policy. Prior to joining the CFTC, Dr. Mixon spent more than 15 years in the private sector. So please join me in welcoming Scott Mixon and the panelists.
We had the slide. The slide. Okay. The basis trade. That's sort of the catch-all term. It's become over the last several years. People use that to describe just the general patterns of futures and cash market activity and treasuries that they've seen, and the role of hedge funds in arbitraging the Treasury cash futures basis, or the basis trade, has been widely discussed, including at last year's conference. And at last year's conference, there was no single panel on the basis trade, but it went through every panel, and it was in the speaker's remarks. And at the time, not a lot of attention had been paid to the underlying factors, or we hadn't figured out some of the underlying factors that cause those patterns to exist. Now, what the world has seen really refers to the data behind me on the screen every week, and that's the CFTC's Commitments of Traders report. It's published every Friday afternoon, and it shows that asset managers, this broad group, has been persistently net long over the past few years, and hence they've been this demand for long Treasury futures exposure. And leveraged funds, if you look at the report, have offset this with their short exposure. They've been basically the mirror image of the asset managers. Now, this panel is designed to go beyond these headlines and focus on the asset managers, the long side. So the goal is to understand the factors influencing their choices among the different Treasury instruments and related instruments that are available to them, so cash instruments, repo, futures. We'll also let them talk about other derivatives. We'll let them talk about interest rate swaps or total return swaps, forwards in the context. And they'll specifically talk about some of the regulatory, accounting, and market factors that influence the different types of asset managers in their portfolios. So to do this, we've assembled this outstanding group of thought leaders and practitioners, and they have a range of perspectives in the asset management space. So I'll introduce To you, to my left, I have Joe Demetric, Senior Vice President within MetLife Insurance Investments. MetLife Insurance Investments provides the insurer investment function for MetLife's general account. And Joe is the head of derivatives trading and brings over 30 years of experience in the financial markets to this role. To his left, David Eichhorn. David is Chief Executive Officer and Head of Investment Strategies at NISA Investment Advisors. He's also Chairman of the Investment Committee and a member of the Management Committee there. NISA Investment Advisors focuses on large institutional clients and is the largest U.S. manager of LDI strategies. We have David Rogel next in line. He's head of total return and inflation portfolios at BlackRock. He's managing director and portfolio manager in BlackRock's fundamental fixed income group, a member of the FFI Executive Committee. He is a member of the Treasury Borrowing Advisory Committee. And farthest on the left, my left, is Greg Peters. Greg is the co-chief investment officer of PGIM Fixed Income and a co-head of the firm's multi-sector team. We may have joining us in a few minutes Mohit Mittal, who will join us at the end. He is the Chief Investment Officer, Core Strategies, and a Managing Director at PIMCO. He's a member of the Investment Committee there and a portfolio manager for a range of fixed income portfolios. And he is the Vice Chair of the Treasury Borrowing Advisory Committee. So let's begin. David Rogel. The Treasury Borrowing Advisory Committee, TBAC, meets quarterly with the Treasury Department, has representatives from buy side, sell side, and when they convened this past January, there was a presentation responding to the charge to examine the drivers of investor preferences for futures, cash, instruments like that. So you're a member of the TBAC. Could you start off the conversation, refresh us on that presentation? I think it sort of changed the discussion a little bit. Can you tell us the key discussion and findings?
Sure. And thank you, Scott. And it's great to be here, and it's a privilege to present TBAC's work on this topic. So looking forward to it. I would also echo some of Scott's comments that the way Treasury posed the question and the work that came out of this, I think, helped to paint a fuller picture of the conversation around the investor landscape and Treasury futures. A lot of discussion on the basis trade, less discussion on why it exists and who takes the other side. And I'll start by reviewing the conclusions of the work at a high level, which is that the committee found that asset managers do have a structural preference to own Treasury futures. And this is really driven by asset allocation needs and a switch out of Treasuries into credit, being overweight credit to enhance yield versus benchmarks. This creates a structural demand and a structural richness in Treasury futures that then hedge funds can take advantage of in leveraged relative value and basis trading strategies. So that's a high-level conclusion. We look through the CFTC data to start in the presentation, and what we find is that we've seen a very large open interest increase in Treasury futures over time, and that's really grown with the overall size of the Treasury market. But importantly, if you look at the size relative to the Treasury market, it has increased recently to around 15% of open interest is around 15% of the Treasury market ex SOMA. So you have seen a modest re-leveraging. And also echoing Scott's comments, if you look at the investor breakdown, there's been this persistent rise in asset manager exposure. It's reached recently over $1 trillion in notional terms. Simultaneously, there's been an increase in the leverage fund short position to over $1 trillion, and the two are almost the mirror image of one another. So why is that the case? So digging into the next part of the conversation, I'll focus really on the asset manager portion of the charge. And the first question that's asked is, why do asset managers use Treasury futures? And is it possible that active duration and curve positioning is responsible for the changes in asset manager exposures? And the short conclusion is that it really can't explain the structural rise that we've seen. The committee looked at an empirical duration analysis of 20 large asset managers and found that even during periods where managers were trading short their benchmarks, you still had this positive net futures position. And it did seem to correlate somewhat with shorter term fluctuations, but it couldn't really explain the overall trend. The presentation also discussed in more detail why asset managers would prefer futures over repo and treasuries. And there are really 4 reasons that were cited. The first is operational simplicity. So futures offer an amount of operational simplicity, especially across many accounts, that you can't get with repo. Second, there's large portions of the industry, for example, institutional separate accounts, where guidelines or investment management agreements don't allow repo. Third, the regulatory structure around 40 Act funds for a while made it easier to use futures from a leverage standpoint. And lastly, there's a FINRA rule that requires 40 Act funds to report interest expense from repos into their operating expenses in prospectuses. And in 2018, Morningstar made a change to the reported expense ratios, including interest expense. And so what this created was a communication challenge for some managers that were using repo relative to managers that were using futures, because suddenly they looked more expensive, even though in practice, economically, it was either equivalent or cheaper to use repo. So those are really many of the reasons why we see this gravitation towards futures in the asset manager community. And next, the question really comes back to why is there this structural long position in futures? And it's important to look at the categories. So if you look at the largest retail fixed income category, it's intermediate, core, and core plus. And most of these, it's over $2 trillion category, and most of these managers are benchmarked to the Bloomberg Ag Index. And over the last 20 years, we've seen the Ag Index go from a 20% Treasury weight to around a 45% Treasury weight, very concentrated as a result of Treasury issuance. And so a couple things are happening. Managers are choosing to own a more diversified portfolio of credit and other assets. And they're also allocating out of treasuries into credit in order to enhance yield. And so if you think about it from a very simple level, managers are selling treasuries to buy corporates or other spread product and buying back the treasury exposure through futures. The simplest example of this is if you buy a floating rate asset, you sell a fixed rate treasury, you buy a floating rate asset, you lose duration, you have to get your duration back in futures. Alternatively, you could have repoed your treasury book to generate that cash, but that would have generated complexity and expense associated with that. So that's the main thrust of it. Just 2 more quick things. To try to validate that hypothesis, the committee looked at 14 large asset management platforms and looked at the AUM-weighted average credit exposure. And what we found was that there has been a significant increase in credit overweights in recent years. And that increase did tend to correlate somewhat with the net futures position. So it supports the idea that this credit demand is driving the demand for Treasury futures. Lastly, there was some work done on estimating the cost, because we know there's a cost to doing this trade. And what we found is that when you compare the performance of the Treasury cash index against a replication strategy with Treasury futures, in the last 6 years, that's cost around 40 to 45 basis points per year to implement in futures relative to cash. And that sounded like a big number. If you look at CTD basis implied repo, you're talking about more like 10 to 15 basis points. But a lot of other factors at work here, including the richness and the deliverable in the futures contract. For example, if you replicate the Treasury index with on-the-runs, you'll see over the roll cycle, those on-the-runs will cheapen over time, and you'd see a similar cost with that type of replication. But importantly, what we found as well is that the average credit spread available in various markets easily hurdled that cost. So it still made economic sense for asset managers to pay that financing cost to go into higher yielding assets. I'll leave it there, but the rest of the presentation really focused on the leverage fund side, which we won't really address, but conclusions there were really that this increase in exposure on leverage funds was really coming from leveraged relative value strategies. There's a bunch of work done by the Federal Reserve to support that. And that this ecosystem has developed where hedge funds are implementing the basis trade or RV trades, and asset managers are on the other side of it.
Wow, thank you for that. That was a very thorough report that the committee did. I think there's a lot to unpack there. We have many panels that we could work from. Let's start. Greg, from PGIM's perspective, from your perspective, some of these dynamics and cross-sectional aspects that David just described from the committee, what resonates with you? So, for example, like the repo issues and futures and those things. What stands out to you as having resonance?
No, so I think David's comments spot on, and quite frankly, this is something I talked about last year, so I sound like a broken record, but I think it's an important topic. On the asset management side, I think it's important to think about how we manage our risks, right? You have, and this is called 3 separate buckets. In one bucket, you have spread risk, you have duration risk, and then let's say you have FX risk. And so you think about those independently. And when you do that, invariably, when spreads are at levels where they typically are, you as an asset manager are benefiting from buying an asset and using a future. So let's just kind of use a stylized, simple example. So I will happily go out and use my cash to buy, let's say, a AAA CLO at SOFR plus 150. I know the drag of using that future is just called 40 basis points to get my duration to where I want it to be, because once again, I'm separating out those risks. So I'm earning a net positive spread of 110 basis points. So from an asset management standpoint, it's about the relative value opportunity around treasuries, right? It just so happens that treasuries don't offer a lot of relative value opportunities. So we're just doing what we think is best as a fiduciary. That's the first thing. I think that is the most critical. And the second is absolutely right. The structural frictions in the system around repo using treasuries are not going away. And that expense issue is a really important issue. What I know you're supposed to be indifferent, but you're not, right? Or more importantly, the folks who sell those funds are not. And so that expense ratio is what is really quite meaningful. But even the dealer community treats repo very different than they do future. So if you open up a new account, as an example, get an ISDA or one of the various stocks that you have to file, there's not even a batting of the eye if they ask, oh, do you use futures? No one cares. But if they say, or if they ask, do you use repo? Well, that changes the whole dynamic. That changes the whole cost function that you get from the dealer side. So there's a structural issue there. One is the relative value, which is seemingly persistent, and the other persistent issue is just a structural bias against using repo and thus treasuries.
Thank you. Let's keep setting up the landscape, and let's move to you, Joe. So you're at an insurance company. So when you hear these comments, what's similar for you? What's different for you from your insurance perspective?
Right. So life insurers, we're offering products out to our customers that have very long durations. They go 10, 20, 30 years plus. So when we're constructing asset allocations to back those liabilities, we're looking to achieve a portfolio that has the basic same cash flow dynamics, same interest rate dynamics as that liability. That's our benchmark, right? We're not benchmarked against the ag. We're looking to outperform that liability. So when we're doing that, we're going to incorporate spread assets, much like other asset managers, into that asset allocation. And a lot of those will either be shorter duration or more intermediate duration. So it makes it challenging to come up with an effective asset allocation match, right, because of that. And what a lot of life insurers will do is they'll look at the derivatives markets to try to close those gaps and have that match with their liabilities. Now, when we do that, we're going to look at the full range of different hedging instruments that are available to us. We're going to look at interest rate swaps, Treasury futures, and also Treasury combined with repo, right? That can either be done explicitly, or we could do it in a OTC derivative contract, something like a Treasury bond forward or a Treasury TR total return swap, where we're effectively capturing those same economics, but we're doing that in a derivatives form. And when we're looking at these different instruments and trying to say, okay, well, what is the best thing? We're going to look at that through some different lenses. That's going to be hedge effectiveness, what the costs are, and the financial statement impacts. So from a hedge effectiveness standpoint, does this instrument match what I'm trying to hedge? Is there basis? And importantly, is there volatility potentially in the basis that may make it a less effective hedge for us? We'll look at costs holistically. So that's going to be things like What's the implied repo or the implied funding costs? But not only that, but what are the liquidity costs associated with different instruments? And also, what are the margin costs? Different derivative instruments have different margin requirements, different types of collateral, whether it's all cash and a cleared instrument versus an OTC derivative where I could use potentially a lot of non-cash bonds off of our portfolio under the uncleared margin rules. So that may be a consideration for people. And the last piece would be financial statement impacts. So for us, our liabilities are largely held at amortized cost. If we're able to achieve hedge accounting on different derivative strategies, then the economics and the accounting more align on our balance sheet. So I would say that's also one area that's maybe on balance a little bit more important for a life insurer than, say, somebody who's operating in a total return framework or total mark-to-market. So I think what we've been seeing as far as trends in the broader life insurance industry is a lot more use of Treasury-based OTC derivative product. There's a few reasons for that. One, from the effectiveness standpoint, or just from a cost, we see lower costs there than, say, using other products like futures or swaps. And also the fact that you can customize those positions. So with a Treasury bond forward, we can isolate certain points of the curve that we want exposure to. We can also adjust the front tenor of when we're going to do that. And that may, it better aligns with our liabilities. And also it allows us to lock in hedging costs over longer periods of time, which if you're doing a rolling strategy, there's going to be some volatility to that. And then the last piece, as far as just on the financial statement impacts, for something like a forward, there are more clear pathways to achieving hedge accounting. You can certainly achieve that using with the other instruments, but it can be certainly much more challenging. Now, that being said, we do have other products, right? We have shorter duration products, and we have products that have embedded optionality. And some of those, like variable annuities, they can require more dynamic hedging, where we have to go in and adjust the hedges on a much more frequent basis. So when we're looking at strategies and how to hedge those types of products, things like liquidity costs become more of a consideration, right? So for those, you would tend to see futures be a larger part of the hedging program, where liquidity costs might weigh some of those other considerations. So for us, it's very dynamic. We will continually look across the landscape and adjust as far as put on different derivatives as appropriate for those.
So did I hear you say at the end, more active is more futures? Is that fair?
I think for certain products, what you will see is more futures usage for those types of products.
Okay. And then to clarify, you mentioned before Treasury-based OTC instruments. So you were thinking instruments. Which instruments?
I think specifically we've seen a lot more in Treasury bond forwards. So that's an agreement where you enter into, under an ISDA with a dealer, you agree to buy a specific Treasury at a specific point in time. Now, that doesn't need to be, that could be an arbitrary period. Right? That could be a year out, 2 years out, potentially 3 years out. So when you do that, what you're doing is you're locking in what are the funding costs associated with that position.
Okay. David, let's continue setting up that landscape. So NISA advises and manages money on behalf of a number of pension funds, I understand. So do these pension funds, do they have different constraints than what you've heard, or is it similar constraints? Are they freer or more constrained to move along these markets? How does that affect your work?
Well, Joe did a great job. I mean, pension funds are very similar to at least a lot of the liabilities in the insurance framework. So I'll maybe circle back to that in a second. I will comment. We're a large active manager against benchmarks, the aggregate, I was about to say Lehman, Barclays, Bloomberg, aggregate index, long gov credit, et cetera. So we are not one of the ones who tend to use futures in those engagements as a way to get long credit. And there's kind of two main reasons for that. A key element of that is just philosophical. We think just being long credit isn't true alpha. You can just get that by buying a credit ETF. You shouldn't pay us active fees for it. And the second part is the cost identified. Yeah, when you ultimately have to fade 40, 45 basis points of cost in the futures market, and you're getting something that has 100 or 150 over spread, your net's still ahead, but you're giving far too much of that risk premium back. And so we don't use them that way or in any real degree. Where we do is coming back to our pension clients. So we are the largest manager of LDI clients in the U.S. We may circle back around. I know the U.K. LDI experience. I never expected LDI to be in that acronym to ever be in the New York Times, and suddenly we were very popular and got a lot of phone calls from people I've never met. But we are the largest manager in the U.S. And importantly, what that means is for decades now, given how clients allocate their money within their pensions, there's usually a demand for duration that their physical bonds cannot satisfy. So we're a very, very large manager of U.S. Treasury strips. So those, of course, are not derivatives, a fabulous way to get a lot of duration, but you still need cash. They're capital efficient. But at some point, if I'll say at this point, maybe the prototypical pension is 40% in risk assets, 50-60% say in fixed income assets. If they're trying to mitigate the interest rate risk in their liability, which is enormous, it's very similar to the interest rate risk that Joe was describing, at least in maybe in your annuity book. If they're trying to mitigate most or all of that, they need to get additional duration somehow. So these liabilities tend to be 14, 15, 16 years in duration. There's a desire for some amount of risk assets on a portion of their portfolio. So the role we play, and other managers similar to us, is we take a portion of their fixed income assets and add some degree of interest rate derivatives. Futures are clearly a great liquid alternative, but we really use the triumvirate that Joe alluded to. Certainly, repo has increasingly become a large part of our book of business, and total return swaps, either on individual Treasury securities or indices of Treasury securities. So at any point in time, NISA has had, let's just say, on average, we've had 100 to 150 billion of notional exposure in some rate market, the vast, vast majority of which is to mitigate a risk, mitigate that pension risk. And I know the term leverage was joked about early in the opening comments. You could describe that as leverage, but there's no monolithic definition, frankly, of leverage. And so when you look at a pension fund is inherently, when it's fully funded, is inherently levered, right? You owe $1 to pension beneficiaries that you've promised, and you're long $1 of assets. So what really the role of derivative is to de-lever the economic risk of that pension. That word can be used in a lot of ways. Sometimes it's demonized, or demonizes usage. As I always describe derivatives like glue. They have good applications like adhesion, and they have very bad applications like sniffing it, right? And we've seen both of those applications in the derivative market, at least in my career. But certainly the pension usage, when scaled prudently, and sufficient collateral, which we've seen in the case of the U.S. for a long time now, we think is a very, very prudent use of derivatives.
Mohit, welcome. We started off with an overview of the TBAC presentation, which covered a lot of different topics, and we followed up on some of the issues that came out there. So you had seen that presentation, you're aware of it. Were there pieces that had the most resonance for you, or pieces where you had a different experience?
Yeah, certainly. I think there are lots of pieces that had really good resonance. I think firstly, as at PIMCO, as almost managing $2 trillion, we are involved across strategies. So, a lot of it in LDI, short duration, intermediate, ag oriented. So similar to my other colleagues involved across strategies. In David's presentation, I think he summarized beautifully the reasons why asset managers tend to have some form of, call it notional leverage, even though it's not real leverage, which included kind of targeted duration management, yield curve positioning, as well as active views. And then the question, which David covered well as well, was the comparison between the usage of derivatives or futures versus usage of repo, and the reasons that were cited. Again, I would agree with some of the reasons with respect to repo limits in accounts, SMA guidelines which prevent the usage of repo, and, a simplification of execution as we have to execute across large number of SMA. Having some proportion in futures allows us to implement it a little more seamlessly than having large number of individual QSIPs across large number of SMAs. Even the discussion around interest expense plays a role as far as mutual funds is concerned. But I think one other area that is quite notable for us is the liquidity considerations. I think if we have to change views, or when we change views and we have to execute in size, having futures allows us to implement that in a little more anonymous manner, relative to kind of having treasuries and then having to go to a broker-dealer and having to seek liquidity that way. So liquidity and anonymity plays a role. I think on that same vein, what could be kind of a way to offset would be having an ability to do all-to-all. Right now, we have, if you have to execute across a treasury, you have to go to a broker-dealer. But there's no kind of a real large all-to-all platform that would kind of enable us to use treasuries little more than futures at the margin. Even the platforms to access the Fed or even the treasury buyback involve going through a broker-dealer. Again, that would be something that could enable asset managers to directly access the Fed as well as the treasury buyback operations could at the margin increase the usage of treasury relative to futures. And then last but not the least, I think what David also had in his presentation was the numbers that he had. He basically highlighted at the asset manager level, the leverage is to the tune of about 20% in futures, but at the levered fund level or the hedge fund level, it's 20x. And I think that is a very, very important thing to focus on. And why that is important is that a 20% leverage essentially means that if that quote-unquote basis trade moves, say, for example, 5 basis points times duration, call it 50 cents, give or take, that means that an asset manager has minus 10 bips of alpha, which is very, very manageable in the context of return objectives, in the context of alpha objectives, and does not trigger any, call it, position change because of that position going against. Whereas if on the other side, on the levered community side, at a 20x leverage, if that position goes 50 basis points against you in an unlevered manner, that means it's a 10 percentage point decline, and that triggers a lot of action unwind. So that's why it is important to kind of, while it is, for 700-800 billion notional of long at the asset manager side, there is a 700 billion notional on the short on the other side. The magnitude of leverage being so much different is quite important.
Thank you. So I'll offer this out to the group. Some of the points that you folks have mentioned involve, say, futures versus repo, which are similar in some respects in terms of the effect on the portfolio potentially. You've mentioned some of the regulatory and accounting differences that exist, and you also mentioned some of the issues like a number of managed accounts perhaps not allowing repo, whereas they might allow futures. So if you had a magic wand and some of those frictions, regulatory differences might be changed, what changes in your day-to-day? Do you still face those frictions? Are things different?
I think you have to clarify the regulatory scheme. So there's a lot of focus on SLR. That's one piece of it, of course. But, there's just so much friction in such a variety of different ways that make repo more challenged. And so I know there's a lot of focus on the basis trade. The question I always ask myself is, so if that didn't exist, what would be the case, right? And what that would be is that Treasuries would be that much higher, which I don't think is the intent of the U.S. Treasury or what is good for, the country, so to speak. So I think we need to kind of work through the various clearing rules, the IMA rules for repo and all these accounts. Like we have to create a sense of indifference, and there's anything but indifference. There's just a predilection for managers, for ease, for everything that's been discussed to use a future, and in most circles, futures are not considered leverage, rightly or wrongly, but repo is. And so that's a stigma and something that I think needs to change through some sort of regulatory coordination and change of construct.
And maybe I'd add to that, most of our clients we don't have 40 Act mutual funds. Our clients are largely pension plans, a lot of which are corporate pension plans. So there's no regulatory limit on using futures versus TRS versus futures. Clearly, there's always simpler is better when it works. But over time, for a host of reasons, but the basis being a huge part of it, and this is why I kind of love how markets work, and efficient markets, is that basis got larger and larger. It was more and more expensive, obviously, to us to keep that hedge in place. It was still worth it. They were hedging an enormous amount of interest rate risk. So if you have to fade 30 or 40 basis points, just do it. But you don't have to. So that was a large education process with a lot of clients to get them comfortable. We'd always really use total return swaps to get them comfortable with repo, and it is an operationally different and far more intensive act. Now that's on the manager and the custodian, not the client, but there was a lot of time spent with clients to say, we really need to add this to our toolkit because, I mean, there's times where the ultra contract, the ultra long bond contract, which is pretty magical for pension funds, it's way out the yield curve, it can trade 100 more expensive to a repo or 100 basis points more expensive to a TRS. So for our clients that use really any degree of a hedge in scale, we've really pushed them, and we have that flexibility to move between the instruments, and we move quite frequently between the instruments because there are times when that ultra action trade's relatively inexpensive, not in a long time, but.
Yeah, I would also very much echo kind of the operational and the infrastructure considerations. So it is far easier to set up a futures agreement or a cleared swaps agreement with one or two or three FCMs, and then you have the ability to trade with a wide variety of counterparties, where you have that one FCM that's clearing it. The margin is standardized. It's largely, again, it's cash for variation margin. To do OTC derivative trading, now you are setting up individual agreements with an array of dealers, right? So you have to negotiate those. You're going through credit. You also, now with the unclear margin rules, you may have to set up initial margin documentation, specific custodial accounts for all that. So if you are already not in a position to do that for other reasons, that's a large hurdle to get over. So that can also contribute to why you may have a preference to using one product or one product set versus another.
I think I agree with everything my colleagues said. I think one other point I would add is that if you just look at the notional amounts, so I think in your chart you had about $900 billion in derivatives. Then when you look in the futures, and then when you look at the notional held by asset managers in cash treasuries. So again, based upon the SIFMA, all the data, using the same definition as CFTC, you get to a number that is between 9 and 10 trillion on the cash treasuries held. So when you say, the futures give or take 7-8% relative to the cash treasuries held. Now, when I do our analysis and say that if all the frictional costs of futures versus repo were removed, how much would that change our futures position relative to increasing our cash treasury and repo was readily available? That number comes out to be somewhere around 15 to 20%. So we would still have, 75, call it, percent in futures. That would be for ease of execution, liquidity, and I think that's how we would think as the differential of frictions versus other factors.
Context, good context. Okay, also for the group, let's think ahead a little bit. So we're in an environment where the supply of Treasury securities has grown, and some of the estimates say that it'll continue to grow. As portfolio managers, how does the market adapt to this, especially when you're thinking about derivatives? So, do you see futures increasing or swaps or other instruments? Does the basis widen or get smaller? How does this impact your portfolio trading as you look ahead?
I would say, the weights in indices will likely continue to rise, and I would expect that this trade will continue to grow in size. And also, as we've seen more inflows and more extension out the curve, you're going to see, I think, the trade grow in size as well. So, at least for the foreseeable future, I think that's kind of the trend.
So, Joe, you and I at breakfast were having a good discussion about collateral and margin and other things. You should have been there. It was good. But we'll
it's exciting stuff.
We'll follow up here. And actually, David Eichhorn, you had mentioned the gilt market volatility, and I think it all ties in together. So I guess the simplest question is, a number of commenters observed gilt market volatility. It involved pensions, LDIs, derivatives, something. They saw volatility and they thought that's bad. Do we have to worry about it here? What's the situation?
So I think from our perspective, when we came out of the financial crisis, right, the emphasis was on derivative counterparty credit risk. How do we reduce it? Right, that was the primary objective, and that's been largely successful. Right, so a lot of the derivatives moved to central clearing. And also we implemented the unclear margin rules. So increasingly, derivatives have more margin requirements. They have initial margin requirements. And you can see this in the ISDA data. The amount of collateral that's being exchanged across the street has been steadily increasing, again, to mitigate a lot of those counterparty credit risk concerns. I think the flip side of what that creates, and I allude this into the costs, is you have more margin needs potentially. And if you're talking about something that's margined in cash, then you need to either hold more cash on your balance sheet, which is going to create more mismatch. It may also create as far as a drag on your returns, or you need to start having more reliance on repo lines. So when we saw the UK gilt crisis and what happened, I think part of the dynamic there was kind of as far as gilt rates were rising, and they had to liquidate those securities to fund their margin needs associated with their derivatives, they got into that loop. So I think as we go now, and we've certainly addressed a large part of those counterparty credit risk issues, but we do need to be mindful of maybe some of the liquidity risk issues that come about of having ever increasing margin requirements in the derivatives markets.
Yeah, I certainly agree. And I think you can never say anything's fully addressed because markets humble us every day, right? But I do think the counterparty risk has been addressed. Curiously, an anecdote I'll share with my colleague Stevens, who's here. One of the last times NISA was at one of these events, it was in 2006 or 7, and that was convened by the Federal Reserve to, I forget the exact name, but the Committee on Counterparty Credit Risk. Ironically, that was in the auditorium at Bear Stearns. So hopefully my participation here doesn't portend anything awful. But on the UK side specifically, and this is not going to be a moment of American exceptionalism at all, I really mean that, there are some major structural differences in the U.S. market and Treasury market versus the gilt market, but also maybe I'll focus more on the LDI side of it. The UK liabilities are much longer in duration for a host of reasons, and they tend to be inflation linked, which makes them longer and a little more squirrely in certain ways, technical terms. So the U.S. market is shorter in duration and nominal in nature, and we have the great benefit of having a much deeper set of instruments to get duration that aren't the D word, so corporate bonds, mortgages, et cetera. So there's just less of a need to add DV01 to hedge the liability. There's still a need, to my opening comments, but it's much smaller in context and wildly smaller compared to the size of the U.S. Treasury market, compared to the size of the UK gilt market. And then importantly, and this comes back, and there are a couple great comments by my colleagues, there's a variety of reasons to use different instruments. One reason we don't rely as much on futures, or not singularly on futures, and this is what happened in the UK, was they are cash margined every day. Importantly, even before the financial crisis, when we were a large derivative manager, we collateralized all our swaps in a bilateral way, not centrally cleared. But we've continued that, and obviously now in most cases it's mandated depending on the instrument. But importantly, a lot of our instruments, whether they be total return swaps or repos, we can collateralize by posting a security, a U.S. Treasury security. So the UK incident started with a pretty bizarre fiscal decision. I won't handicap whether or not the U.S. could ever make such a bizarre fiscal decision. That was the first 50 basis points, let's say, of the rate sell-off. The rest was the doom loop, largely caused by the need to sell the collateral to meet the margin, but you desperately needed that duration, and there's your doom loop started. I think in the U.S. there's at least at NISA, there's such a heavy reliance on physical posting to where we'd be able to post securities, not selling them to start the doom loop. Again, I'll never say never about markets, but I would say the U.S. LDI market is just so much further out of the money on those sorts of risks, pretty ridiculously out of the money as we calculate it.
Yeah, I think David is absolutely right. Like the duration of the U.S. pensions and the instruments that they have, it's a better match versus for UK. the pension liability duration is much higher, so they needed to get to that much higher kind of leverage. And then the second part is the size of the pensions in the U.S. is much smaller relative to the size of the Treasury market, versus in UK the size of the pensions relative to the gilt market. Right? If you look at the private corporate pensions, give or take 2 trillion something, call it 50% held in bonds versus equities, give or take, versus the size of the Treasury market at 25 or so trillion. So that magnitude makes a huge difference in addition to the liability duration difference.
But it's still a cautionary tale, though, in a way, particularly in the U.S., where increasingly funds are less liquid, right? And so we might not have the same kind of doom loop that was well described, but this move towards illiquid assets puts pressure on the ecosystem if, in fact, that does occur, right? Because you don't have the postable collateral, you don't have the things that you can readily sell, and that could create a whole different dynamic. So that's what I worry about, the UK-ish type of LDI crisis here.
So again, to the group, you brought up some of the collateral and margin issues, and on the horizon we have potentially more clearing of Treasury securities, a clearing of repo. So if we go out a year or so, thinking about how much concern over margin or margin changes or those sorts of things impact your portfolio or not for the choices, and more of these portfolios being cleared, how do your answers change, if at all, in terms of how the next couple of years play out?
I feel like I've already spoken a lot. I think one main comment I would say is, maybe I shouldn't admit this, I'm at this conference, but some of the plumbing, there's far more experts at my shop than I am. But I think importantly, when you're using anything that allows cross-collateralization and cross-margining is critically important to us, because notwithstanding how I described our relative use of repo and total return swaps, the more of those, there are times, even for pensions, where we need to short out some exposure on one part of the curve and be long on the other part of the curve. So the ability to cross-collateralize, cross-margin, my answer is kind of, it depends. Depending on how it's done, could be frustrating for kind of our client usage. If it's done well and permits that would certainly be an unequivocal positive for us.
I would just know one thing about the nature of fiscal stimulus now is that whether it's pro-cyclical or structural deficits, in a recession, you're going to have that demand for the safe asset. And one of the reasons why you've had more intermediation on the hedge fund side of things is because we have been running a lot of Treasury issuance, a lot of supply at a time when managers are comfortable owning credit. So that plays a role, and I think I'm also no expert in the plumbing issues, but to the extent that any new changes disrupt that intermediation capacity, that's an important factor to consider.
Okay. I believe we'll have a few minutes if people have questions. So we'll open it up a bit to the audience if we can for Q&A.
You guys did a great job. And I don't say that just because I help organize it, but this is fantastic. You didn't talk as much about the trend increasing. So it seems likely, like if supply increases, that these trends will increase. And I guess I wondered, would the basis then continue to widen? And how do you think about that? Do you have some internal cutoff point at which, well, this is now too high, it's too expensive, and I will begin to shift my strategies? How would you see that if those trends did continue? First, do you think the basis would widen? And if it did widen, how would you see yourself kind of responding over time in a general way?
I think it's a multi-factor kind of equation, right? So, as I kind of described before, there's lots of different components. There's where spreads are, where the basis is. But at some point, if the basis becomes, uninvestable vis-a-vis the opportunity set, then that'll push push investors into treasuries, but we're not there yet. And so it's hard just to point to one factor and one number. It's not X. It depends on kind of, what's the opportunity set around you. But at some point, just given the unrelenting supply that inevitably we're facing, my strong suspicion is that there'll be an incentive to buy cash treasuries, which isn't a great outcome, by the way, but that's kind of how I see it from my end.
Well, I think that's a key. I mean, you hit a really key point that hasn't been discussed yet is really the fiscal situation and the fiscal profligacy of the U.S. government is, we can talk about whether it be hedge funds, and we're not a hedge fund. But what hedge funds are doing are asset managers. But at the end of the day, the basis, particularly I'm focusing on the back end of the curve, is tracking things like swap spreads, which to me is a real measure of a liquidity premium. And lo and behold, when you keep issuing bonds at the pace we are, there's a liquidity premium creeping in. So that creates the cheapness of the physicals, and somebody better step in to short. Far be it from me to say, hedge funds are great, but there has to be, and we do some of those trades. We have cash where instead of owning cash, we just do the basis trade unlevered. And it's a great way to pull that out. So I think that's a critical driver of why the basis is where it is. And obviously no one on this stage can address the supply. I know that much.
Yeah, so for us, I mean, the core reason why we're using a lot of these products to add duration, right, is we have these very long liabilities. And a lot of the spread product is shorter, and that creates a mismatch, right? So if treasuries are a greater percentage of the index, that doesn't affect that equation for myself, right? But if you're benchmarked against the ag, and now a greater and greater proportion of that index is becoming treasuries, and some of that's going to be out the longer end of the curve, you have that similar dynamic, right? In a potential for more of a duration need, whether you do it in cash or you do it through the replications. I think the TBAC did a really good part of the analysis was looking at what are the costs of using futures over time and comparing that to spreads, right? So that's probably ultimately the limiter, right, where it can get to. If people perceive that this is costing more than I can earn on the spread assets, then it doesn't make sense. And I think the other piece of this from a cost perspective is basis volatility, right? So if you take this on, you're taking on a different risk that you have in your portfolio. So to the extent that you start seeing more volatility in the basis, that's effectively a cost, right? And that could also drive people away from doing the basis trade.
I would add, and just echo Greg's points on the multi-factor aspect of it. If we go into a recession, you're going to see bond flows accelerate, and you're going to see a preference for safe assets. Even if we have additional treasury issuance, it's entirely possible that demand comes through from the money manager community, and you don't see the basis move. And it really does depend on the relative valuation. March of 2020 was a good example where Treasury futures basis blew out, off the run spreads blew out, but high quality spreads blew out everywhere. And so it still made sense to hold on to those assets on a relative basis. So it really is a dynamic problem.
Yeah, I was going to say the same. Basically, the valuation in isolation of the basis, but then also in relative to other areas, right? So, and other sources of funding as well. So all of that will go into the determination of usage of futures versus cash for active managers.
Ira Jersey, Bloomberg Intelligence. Thanks very much for the panel. I'm going to sit down now so I don't block Spoopy behind me. So you mentioned just now very briefly about swap spreads and kind of liquidity preference. How over the last decade have your portfolio shifted with the LIBOR transition to SOFR and with swap spreads so negative? How should investors and other users think about that relative value and how those other instruments besides futures can be used to generate leverage?
The easy answer for us, we were probably, Ira, great question. We were probably 90% interest rate swaps, back in the old days. We effectively use them zero now. So wild transition for a host of reasons. A big one though is the introduction of the ultra long bond. We couldn't really get the right yield curve in a lot of spots. So, but then a lot of the other measures we've talked about, and importantly, a build out on our end. We couldn't do repo or effectively 10 plus years ago. Now we do it kind of day in, day out, and we just had to build that out.
One factor for us is base curve. So, even though it might make sense it's still preferable for us to stick to Treasury base curve with futures, which is the index effectively, compared with swaps. So that's a major consideration, whether or not you want to take on swap spread basis risk or futures basis risk.
Yeah, I think same. Like swap spreads have tightened quite significantly, look reasonably rich. So certainly not a reason, at least for us, to kind of have a long exposure through swaps. Preference for usage of Treasury and then when needed, usage of futures. So again, in that relative context, at the margin supportive for usage of future relative to swaps, given where swap spreads are.
So perhaps we could do one more if anyone has one.
Oh, hi. I guess I'm the last one. Is this on? Yeah. So Josh Younger from here, the New York Fed. And I guess my question's on this credit overweight, which seems to be the thing that everything turns around among asset managers, because that pensions and insurance companies would produce liabilities that are different from what the credit markets produce for high-grade corporations is not surprising. But to some extent, it seems like if enough asset managers are overweight front-end credit, that should be self-correcting. And yet it's persistent for many years. And without that, it seems like there's a lot less need for long futures, a lot less need for basis, a lot more need for matching the index more precisely. And so, I hear yield enhancement, but when everyone does yield enhancement, there shouldn't be more yield enhancement. So, why is this happening? I guess is sort of my question, very open-ended.
I think there's this desperate need for income and return and performance. So I think it's as simple as that. I don't think it's this nebulous kind of story. Investors, invest with funds such as, us in various different forms to achieve a certain objective. And that objective function is to generate income and return. And having that additional spread in a portfolio managed in a thoughtful way is additive to that end buyer. So that's how it is today. I think it's also important to state that there's not been a credit cycle in over 20 years, so time will tell. But we've been in a very benign environment for credit. There's this perception that central banks are there at the ready to kind of help out in times of need, so to speak, rightly or wrongly. It's been the right call by and large. So, that could change, but something has to change fundamentally. So it's a response to the underlying environment, nothing more than that, in my humble opinion.
No, I think it's part of the competitive landscape, right? As far as by introducing spread assets into portfolio asset allocations, you can offer more attractive pricing as far as to clients, rather than just having a Treasuries only asset allocation against that portfolio. Life insurers are very well positioned to be holders of corporate credit. We're long-term in nature, that's our perspective, and we want to diversify that portfolio. So when you look at the spread markets, not every corporate issuer is issuing 20 or 30-year bonds, right? We want to diversify issuers across everything, and a lot of that will involve doing things either in the loan market, which from an interest rate perspective is essentially zero, or things more in the 5-year or the 10-year part of the curve. So again, for us to achieve that diversification, a lot of times you're buying things shorter dated.
Maybe I make one last point, provocative one. I know where I'm sitting right now, but I think the rapid intervention by the Federal Reserve at times is certainly very warranted, but undoubtedly it's a huge moral hazard. And the simple fact is, I think a lot of investors and managers feel I'll be okay because I'll be bailed out by being overweight a lot of spready product. And I think that's something policy groups need to think about hard and long about.
I would also reiterate something we spoke about earlier, which is this benchmark composition. So if the Treasury weight goes from 20 to 45, and you're an active manager, and so you're always looking at your active portfolio and optimizing your active risk versus your benchmark, and you're saying, okay, look, I can't take too much tracking error. I want to deliver a strong information ratio versus my benchmark. I think as the benchmark compositions change, there's also a little bit of a rethinking on, do you want to just look at it that way? Do you just want to look at your alpha only, or do you want to try to provide a more diversified portfolio and take on more tracking error structurally? So I think that's another part of the conversation as the benchmark has evolved.
And just one quick thing from my side, in addition to what my colleague said, I think if you look at the last 12 years, 13 years since GFC, what you have observed from flow, from flow of funds with respect to what kind of strategies the funds have gone into, they've gone from more, call it, ag or higher duration oriented strategies into more credit oriented strategies. So while in isolation you can say that there is that little bit of, call it, credit, front end credit, in aggregate, in many ways I would say the market has less duration exposure than what it had pre-GFC from an aggregate kind of flow data based upon the last 15-year data. So in an environment where there is any kind of economic activity decline or shock, I think you would see more flow into kind of the interest rate sensitive or interest rate oriented strategies, and that again would be supportive for the demand for treasuries.
Okay, well, at the outset, I promised you an outstanding set of panelists, and I think they definitely delivered. It's been a fantastic conversation with a number of things to think about beyond this. But if you would join me in thanking them, I think we're done.
Thanks, Scott, for running that panel extremely well, and thank you to all of our panelists for your interesting and even provocative comments. We appreciate that. At this time, we are going to do our first audience poll question. So I am waiting for a QR code or Slido code. So now it's audience challenge time to, on their device, go to slido.com, and you can use that password number or the QR code. And we're going to go into our first poll question. So as hopefully most of you are aware, the most recent IAWG staff report was published within the last week. So we would like to ask a question related to that. So looks like people are figuring it out. All right, it seems like results are still coming in, but it seems like we have a clear winner with central clearing proposal appearing to have more votes than the other four categories combined. So I'm sure one of our afternoon speakers will be very happy to see that. Well, I'll let you keep on voting, but we'll push on to our next speaker. So I'd like to introduce Michael Barr, Vice Chair for Supervision at the Federal Reserve Board of Governors, who will be providing keynote remarks. Mr. Barr took office as the Vice Chair of Supervision of the Board of Governors of the Federal Reserve System in July 2022. He also serves as a member of the Board of Governors in the Federal Open Market Committee. Prior to his appointment to the board, Mr. Barr was the Dean of the Ford School of Public Policy and the founder and faculty director of the University of Michigan Center of Finance, Law, and Policy. Mr. Barr served as the U.S. Department of Treasury's Assistant Secretary for Financial Institutions from 2009 to 2010. He also served at Treasury in the Clinton administration. And we will reserve some time for Q&A after the remarks. So please join me in welcoming Vice Chair Barr.
Thank you, Brett, and thank you all for the opportunity to speak with you today. It's great to be here again, particularly because this year marks, as you've heard before, the 10th annual conference on the Treasury market, a milestone that is worth celebrating. I want to acknowledge the Federal Reserve Bank of New York for its leadership in this area, including the dedication and excellence it has brought to hosting this conference over the past decade, in collaboration with the Interagency Working Group on Treasury Market Surveillance, led by the Treasury Department. The Treasury market is the means by which our government meets its financing needs in service of the American people, and it is also a bedrock of the financial system. Promoting the resilience of the Treasury market and ensuring it can continue to fulfill these roles requires the collaboration of agencies and individuals across the government, along with the private sector. As others have pointed out today, we have made important progress since last year's conference. The Securities and Exchange Commission has finalized a rule on central clearing of Treasury securities. The Treasury Department has initiated a program for buying back less liquid Treasury securities. And the Office of Financial Research is preparing for its permanent collection of data on non-centrally cleared bilateral repurchase agreements, which will support our understanding of this market as it evolves. I will share some thoughts with you on how I see the work of the Federal Reserve in supporting Treasury market resilience. Our capital and liquidity regulations, our supervision of the firms over which we have authority, and our liquidity facilities play important roles in supporting market resilience and financial stability. Earlier this month, I gave a speech where I reiterated the crucial role of capital in serving these objectives and the need to balance resilience and efficiency in designing our rules. In that speech, I also outlined the elements of a capital reproposal that I believe will have broad consensus at the Federal Reserve Board. The adjustments are in response to a robust public comment process, and some of them are designed to address interactions and market functioning concerns raised by commentators. In terms of rulemaking, today I will focus on some additional aspects of our regulatory framework, namely enhancements to our liquidity regulations. I will share some perspectives on how our liquidity regulations work together and are supportive of market functioning and the smooth implementation of monetary policy. We consider how all of the Fed's tools work together to support our objectives. In previous speeches, I've talked about the role of the discount window and the standing repo facility in supporting both monetary policy implementation and financial stability, noting how important it is that eligible institutions be ready to use those facilities. Today, I want to dig deeper into this topic, including how these tools support monetary policy implementation through appropriate incorporation into liquidity regulations and supervisory practices. After the banking stress in March 2023, we saw substantial improvement among banks of all sizes in their level of readiness to tap the discount window, both in taking the necessary steps for setup and in their pledging of collateral. Since that time, over $1 trillion in additional collateral has been pledged to the discount window, and additional banks have established access to the SRF. Both of these facilities are potential venues for monetizing assets and raising liquidity to address volatility in private funding markets or gaps in the availability of private market funding. We had been hearing that some were confused about how banks could incorporate ready access to the discount window and the SRF into their contingency funding plans and internal liquidity stress tests. Supervisors have a role in assessing the viability of large banks' plans to meet stressed outflows in their stress scenarios. And we have been asked whether the discount window, the SRF, and also Federal Home Loan Bank advances can play roles in these scenarios. The answer to this question is yes. We provided clarity to the public in August on permissible assumptions for how firms can incorporate the discount window and the SRF into their internal liquidity stress test scenarios. There are a couple of principles that underlie our response in the frequently asked questions we posted on the board's website. One principle is that our tools are readily available to firms. This means that we see it as acceptable and beneficial for firms to incorporate our facilities to meet liquidity needs in both planning and in practice. If firms plan to use our facilities, we expect them to demonstrate ex ante that they are fully capable of doing so, including through test transactions. An additional principle underlying our approach is that while firms should be ready to use a range of funding sources, firms need to hold sufficiently highly liquid assets to meet their potential liquidity needs. That is, they need to self-insure against their own liquidity risks. A third principle is that firms should be ready and able to use private channels to turn those assets into cash, in addition to any public channels they may plan to use. I want to dig a bit deeper into the benefits to both individual firms and the financial system when firms incorporate Fed facilities into their stress preparedness planning. Again, a design feature of our liquidity regulations is that large banks must self-insure against major liquidity risks. Our regulations also provide flexibility in terms of the portfolio composition such banks use to do so. This flexibility allows them to adjust their portfolios based on market conditions and firm needs. A key component of this flexibility is that reserves and certain high-quality liquid assets, such as Treasury securities, are equivalent in terms of being treated as the highest quality of liquid assets. This feature is important because, while it allows firms to manage their liquidity buffers more flexibly, it also allows for greater flexibility in our monetary policy implementation, and it supports market functioning. We have heard over the years, however, that the degree of substitutability among these assets has been limited in part by concerns about capacity and stress for the market to turn securities into reserves immediately. These concerns are valid. This constraint can be addressed in part by the appropriate incorporation of Federal Reserve facilities into monetization plans and as firms' internal liquidity stress tests. When firms understand that they will not be fully constrained by the capacity of private markets or their individual credit lines to monetize high-quality liquid assets immediately in stress, they can reduce their demand for reserves in favor of Treasury securities, all else being equal, for their stress planning purposes. This dynamic improves the substitutability of holding reserves and holding Treasury securities, either outright or through repo transactions. When banks exhibit a high degree of substitutability of demand for these assets, money market functioning improves. Let me explain with an example. If a bank sees holding reserves and investing in Treasury repo as near substitutes in its liquidity portfolio, it should lend into Treasury repo markets when repo rates rise above the interest rate earned on reserves. When banks can nimbly adjust portfolios in response to price incentives, the efficacy of reserves redistribution through the system improves and market functioning is enhanced. In aggregate, this activity can prevent rates from rising further, all else being equal. The point at which banks in the aggregate have a relatively immutable demand for reserves and are unwilling to lend them out is evidence of when a small decrease in the supply of reserves results in a sharp increase in the cost to borrow them. Our monetary policy tools are well positioned to help us avoid such an outcome. But of course, greater willingness of banks to reallocate across close substitutes should help avoid the emergence of sudden pressures in money markets by reducing money market frictions. In 2021, the Federal Reserve launched the SRF, which, along with the discount window, should help cap upward pressure in repo markets that could spill over into the federal funds market. Use of these facilities also increases the supply of reserves in the system. The enhanced clarity for firms that Fed facilities are a fully acceptable venue to get same-day liquidity for their HQLA should help reassure firms about holding reserves and their close substitutes, such as Treasury securities, in their liquidity portfolios. Of course, as I stated earlier, for the largest banks, there is a requirement that they hold high-quality liquid assets to address their own liquidity risks. They must also be ready to use private markets to monetize these assets. It is also critical that banks recognize and manage their interest rate and liquidity risk of their securities portfolios to ensure that those securities held for liquidity purposes can be monetized in a stress without creating other adverse effects on a firm's safety and soundness. In 2022 and 2023, certain large banks did not effectively manage the risks of rising rates and suffered significant fair value losses on their securities holdings, including those in their held-to-maturity, or HTM, portfolios. These losses affected their ability to respond to liquidity stress, as monetizing the assets could result in realizing losses. When the banking stress hit in March 2023, those securities could not be sold to meet stressed outflows because large unrealized losses inhibited their sale without significant capital implications. This is further complicated in the case of held-to-maturity securities, which cannot be sold without risking a revaluation of a firm's entire HTM portfolio. Selling HTM securities to generate liquidity would therefore have had a particularly large effect on these firms' capital levels, likely increasing the stress on these firms. Further, some firms were unable to rely on private channels, such as repo markets, for monetization because they were not prepared, they were not regular participants in the market, and market participants were unwilling to lend because of counterparty credit concerns. This combination of factors meant that HTM securities that had been identified for banks as available to serve as a liquidity buffer in stress could not effectively serve that function. As I've mentioned before, to address the issues that we learned about liquidity in the spring of 2023, we are exploring targeted adjustments to our current liquidity framework. Many firms have taken steps to improve their liquidity resilience, and the regulatory adjustments we are considering would ensure that large banks maintain better liquidity risk management going forward. Improvements to our liquidity regulations will also complement the other elements of our supervisory and regulatory regime by improving banks' ability to respond to funding shocks. Specifically, we are exploring a requirement that larger banks maintain a minimum amount of readily available liquidity with a pool of reserves and pre-positioned collateral at the discount window based on a fraction of their uninsured deposits. Community banks would not be covered, and we would take a tiered approach to the requirements. The collateral pre-positioned at the window could include both Treasury securities and the full range of assets eligible for pledging at the discount window. It is vital that uninsured depositors have confidence that their funds will be readily available for withdrawal if needed, and this confidence would be enhanced by a requirement that larger banks have readily available liquidity to meet requests for withdrawal of these deposits. This requirement would be a complement to existing liquidity requirements, such as those in the internal liquidity stress test that I described earlier, as well as meeting the liquidity coverage ratio. Incorporating the discount window into a readiness requirement would also re-emphasize that supervision and examination view use of the discount window as appropriate under both normal and stressed market conditions. In addition, as I've previously discussed, we identified significant gaps in interest rate risk management in the March 2023 banking stress, including in portfolios of highly liquid securities. Relatedly, we saw that banks face constraints in monetizing HTM assets with large unrealized losses in private markets because they were unable to repo these securities or sell these securities without realizing significant losses. To address these gaps, we are considering a partial limit on the extent of reliance on HTM assets in larger banks' liquidity buffers, such as those held under the LCR and ILST requirements. These adjustments would address the known challenges of banks being able to use these assets in stressed conditions. Finally, we are reviewing the treatment of a handful of types of deposits in the current liquidity framework. Observed behavior of different depositor types during times of stress suggests the need to recalibrate deposit outflow assumptions in our rules for certain types of depositors. We are also revisiting the scope of application of our current liquidity framework for large banks. These enhancements to our liquidity regulations will help bolster firms' ability to manage liquidity shocks, and they also be well integrated into our monetary policy tools and framework. Turning back to the discount window, I also want to note that the discount window has served its role well in recent years and that we are engaging in ongoing work to improve its operations. Given the crucial role of the discount window in providing ready access to liquidity in a wide variety of market conditions, we continuously work to assess and to improve its functionality while engaging with current and potential users of the window. Among the steps we have taken recently include that we have now an online portal, Discount Window Direct, that allows firms to request and to prepay discount window loans in a more streamlined manner than was previously possible. We also recently published a request for information on discount window operations and daylight credit, asking about key components of these facilities. Feedback from the public will help us prioritize areas for improvement. So I strongly encourage anyone with an interest in this topic, which I gather would be most of you in this room, to weigh in during the comment period. Your feedback will help us to ensure that the discount window continues to improve in its role providing ready access to funding under a variety of market conditions. Thank you very much, and I look forward to your questions.
Jim Tabaki, Independent Dealer Association. Mr. Vice Chairman, I appreciated all of your comments about the discount window and the standing repo facility. The question I have is, there are many participants in the Treasury market, has intermediaries that are independent dealers that are neither primary dealers or banks. And opening up these facilities to a part of the market that is, by our measure, 15 to 20% of the intermediaries that play in that market would go a long way. You can't eliminate 15 to 20% of the intermediaries and really cover liquidity risk in a spiking situation. What are your thoughts there?
Well, thank you. As you know, under the Federal Reserve Act, absent unusual and exigent circumstances, we're limited in the counterparties that we can have in our standing facilities, and so those facilities are available essentially to banks.
Yeah. Hi, Cheryl King from the Bank of Canada. My question would be around efforts to mitigate the stigma of the discount window. It's often argued that the FHLB is a preferred source of funding for liquidity needs because of the implications of accessing the discount window is that you are in a crisis. Do you feel like these efforts that you're trying to put forward are going to eliminate the stigma, or is it going to mitigate the stigma?
Thanks. It's a great question. I mean, the problem of stigma and the discount window has been a long-standing one. Really, since shortly after the creation of the discount window, there have been concerns that using it might be seen as a sign of weakness. And, you know, one of the messages that I've been trying to convey in speeches I've given over the last couple of years is that we don't view it that way. We view use of the discount window as a fully acceptable, normal part of any bank's funding needs. If it makes sense for them to use it from a financial perspective, if it makes sense for them to use it because of gaps in private market sources, if it makes sense for them to use it for contingency planning, we want banks to use the discount window. So a part of what we're doing is messaging that we believe that the discount window should be used by banks when it makes sense for them to use it. And many of the other kinds of steps that I've described are designed to sort of put our money where our mouth is on that.
Priya Mishra from JP Morgan Asset Management. Question, Vice Chair Barr, on the supplementary leverage ratio. Any thoughts there if, as the Treasury market grows in size, if that is a limiting constraint for balance sheet of dealers? Is that something that the Fed is thinking about?
The question is, how are we thinking about the composition of our balance sheet?
or how you're thinking about the recalibration potentially of the supplementary leverage ratio.
I'm sorry, my hearing has gotten a little bad, so I'm not sure I caught the end of the sentence. So,
the SLR.
Oh, I'm sorry. Thank you. We have been and are looking at all of our capital rules, including the ESLR, to think about how they relate to Treasury market functioning. That's an area that we'll continue to explore. We don't have any current plans with respect to the ESLR at this time.
It's okay. I had the same question.
Thank you, Vice Chair Barr. Mark Cabana from Bank of America Securities. With regarding your comments around partial limitation for large bank HTM, how do you envision that will be calculated or calibrated? And when do you expect that the public can learn more detail through a potential more formal proposal along these lines?
We're looking at the appropriate calibration. It's at this time we haven't made a firm decision about what the right level is. We're looking at the experience of the last couple of years. We're looking at practices that larger banks currently use, and I expect that we'll have a proposal either later this year or early next year for people to look at and be able to dig into the substance in more detail. We'd, of course, put it out as a proposal for public comment and get feedback from the public and affected institutions. So I look forward to getting that feedback as part of our process. I think I've exhausted you. Thank you very much.
Thank you for those remarks and those good questions. We're going to take a break now. We'll reconvene the conference in about 20 minutes at 11:15. Everyone, welcome back. We're going to restart the conference here. It's my honor to introduce Janet Yellen, the Secretary of the Treasury, who will be delivering keynote remarks. Janet Yellen is the 78th Secretary of the Treasury of the United States, a role she's held since 2021. Prior to serving her current role, Secretary Yellen served as the chair and member of the Federal Reserve Board of Governors, as well as chair of the White House Council of Economic Advisors and the president of the San Francisco Fed. Outside of her extensive public service, Secretary Yellen was a professor emeritus at the University of California at Berkeley, where she was a professor of economics. She's currently a professor emeritus there. Sorry. Please join me in welcoming Secretary Yellen.
Thanks so much, Brian. It's a real pleasure to be here. It's familiar terrain. Lovely to see many familiar faces. I'm very glad that I'm able to join you for this 10th annual Treasury Market Conference. It's a conference that helps the government identify ways to further improve the functioning and resilience of the Treasury market, which is, of course, core to the functioning and resilience of the U.S. financial system as a whole. And this makes it a fitting place for me to share my thoughts on the work that my colleagues and I across the Biden-Harris administration have done to navigate financial stresses and strengthen the U.S. financial system over the past 3.5 years. In my remarks today, I'll address why this work is so important, our approach to achieving a healthy and resilient financial system, and what we've accomplished. The importance of a resilient financial system. I focused on financial stability as Treasury Secretary and throughout my career because of a deep conviction concerning the importance of the U.S. financial system to U.S. economic prosperity. I've seen through many business cycles and financial stresses that a strong, dynamic, and resilient financial system is key to a strong, dynamic, and resilient economy. When the financial system works as it should, it helps American households finance home purchases, save for their children's education. It enables businesses to get the capital they need to grow and hire and invest in new innovations. It allows households and businesses to manage their risks so that they're prepared for the future. Our strong financial system was crucial to our historic economic recovery, with banks continuing to lend and provide other critical services throughout the COVID-19 pandemic. Now our financial system is crucial to our medium and long-term economic agenda, supporting the record growth in new business applications we've seen under this administration and the massive investments in infrastructure, clean energy, and manufacturing that are at the heart of a strategy I've called modern supply-side economics. We should also never forget what happens when the financial system does not work as it should. During the global financial crisis, the collapse of large and complex financial institutions and fragile short-term funding markets spread stresses through the financial system and then to the real economy. More than 8 million Americans lost their jobs, the unemployment rate rose to 10%, and the net worth of American households fell by more than $10 trillion. The recession was the deepest since World War II, lasting 6 quarters. All of this leaves no question about the need for a resilient financial system. But in January of 2021, I stepped into a Treasury Department whose focus on financial stability had all but disappeared. I knew that this could lead to devastating results for American families, businesses, and financial institutions. So I worked to restore our government's focus on financial stability and to craft an approach to build and maintain a financial system that households and businesses can count on day to day and that supports economic prosperity in the long run. Our approach includes a focus on shoring up strong core foundations of the financial system, including safe and sound financial institutions, financial market utilities, and central clearing counterparties, protections for investors and consumers, and financial market integrity. We also, however, recognize the necessity of considering the stability of the system as a whole. We see that connectivity between different financial institutions and markets, from direct linkages to correlated trades, can create outsized effects on the broader financial system and on our economy. This understanding is rooted in recent history. In the aftermath of the global financial crisis, the United States and other countries enacted important financial reforms and pursued new macroprudential policies focused on mitigating systemic risk. At home, there were some who strongly opposed the Dodd-Frank Act, arguing that its regulation would hold back innovation and economic growth. I and many others insisted on the opposite. Appropriate regulation is critical to supporting a resilient financial system that serves as an engine for innovation and growth. I believe our view has been borne out. Critics' warnings, for example, that regulation would undermine the competitiveness of U.S. banks, that did not come to pass. Reforms strengthened the financial system, including by equipping banks with substantially more and higher quality capital that made them better positioned to extend credit to households and businesses that needed it during the pandemic. But we're well aware that financial intermediation continues to evolve, including in response to reforms. The pandemic also caused profound financial market disruptions, like the global dash for cash in March of 2020, revealing additional vulnerabilities, including in short-term funding markets. Finally, our approach reflects the importance of collaboration and communication across regulators and other authorities. Responding to financial crises requires swift, coordinated action. Identifying vulnerabilities requires sharing insights. We recognize this need in the aftermath of the global financial crisis as well, and established the Financial Stability Oversight Council to inform a more holistic view of an approach to risks. But the Council was severely weakened during the prior administration. When I took office, the number of Council staff had been cut to single digits. The Council's analysis team at Treasury, which monitors systemic risk, had been eliminated. The infrastructure supporting interagency engagement and coordination had been significantly scaled back. Put simply, we were without crucial tools to identify and help respond to risks to financial stability, and this meant we faced an increased likelihood that risks would materialize into negative impacts on American households and businesses. So we rebuilt FSOC, scaling up staff and increasing opportunities for agencies to come together to share expertise and insights. FSOC's new analytic framework for financial stability risks is also critical, identifying key vulnerabilities, transmission channels, and authorities to mitigate risks. This positions the Council to take more effective action and increases public transparency. Let me now turn to how we've deployed this focus on core foundations, the system as a whole, and collaboration and communication to meet challenges in 4 key areas. I'll address how we improved the resilience of the Treasury market, implemented an effective and targeted response so that the regional banking stress in 2023 did not derail our recovery, addressed the diverse risks posed by the evolving non-bank sector, and tackled cross-cutting risks. And I'll also speak to our global work. Given where we are, I'll start with the Treasury market. As this audience knows well, the Treasury market carries out a range of critical functions. Treasury securities are used to finance our government at the lowest cost to the taxpayer and by the Federal Reserve to implement monetary policy. A strong Treasury market helps underpin the role of the dollar in global transactions. And Treasuries are a major fixed income asset for investors around the world and serve as collateral for a wide variety of transactions. They're also used as a reference benchmark for global asset prices. So, since the start of this administration, our focus on strong core foundations has led to wide-ranging work with other agencies and the private sector to strengthen the Treasury market so it remains the deepest, most liquid market in the world. Even as there's always more to do, we've made significant progress and documented it each year, publishing the latest report just last week. We've supported transparency and enabled the government to better assess vulnerabilities by increasing the availability and quality of data on Treasury market activity. For example, just this year, we've made more information on Treasury market trading activity available to the public. And we'll soon begin collecting transaction-level data in the non-centrally cleared bilateral repo market, likely the largest repo market segment in the U.S., and, concerningly, the one for which the least information has been available. We're helping bolster market liquidity through a new Treasury buyback program that provides regular opportunities for dealers to sell off-the-run Treasuries back to Treasury. Buybacks also strengthen Treasury's cash management, including to reduce borrowing costs over time. We've made progress in standardizing risk management through the SEC's adoption of a new rule to expand central clearing in the Treasury market. And we've increased consistent regulatory oversight and enhanced investor protection with a rule clarifying when liquidity providers are required to register as dealers. But as I laid out, our approach considers not just strong core foundations, but also the stability of the system as a whole and the need for strong communication and coordination. Our response to the regional banking stress in 2023 showcased how we're making good on all these aspects. A year and a half ago now, Silicon Valley Bank and Signature Bank experienced runs that were particularly large and fast by historical standards. These banks had seen rapid deposit growth, especially in uninsured deposits, as well as significant unrealized losses on their securities portfolios. Their runs were followed by deposit outflows from other regional and mid-sized banks that were perceived to have similar weaknesses. We knew we needed to mitigate what was a serious risk of contagion, so we acted decisively. Regulators moved quickly to close the banks, and after receiving recommendations from the boards of the FDIC and the Fed and consulting with the President, I approved invoking the systemic risk exception during that first weekend. This enabled uninsured depositors at these banks to have access to their funds on Monday morning so they could pay their employees and suppliers. And that same weekend, with my approval, the Fed established the Bank Term Funding Program to limit broader contagion. Our efforts were successful, building on the base of a banking system strengthened by the reforms following the global financial crisis. We prevented contagion that could have destabilized the broader financial system and derailed our economic recovery. And we made sure that American taxpayers didn't bear the cost. We're well aware, however, that we need to address the core weaknesses these banking stresses revealed, and we urge moving forward on key next steps. We need greater supervisory attention on banks with less stable deposits, and we need regulations that account for unrealized losses on securities. We also need changes so that banks are better prepared for liquidity stress, such as making sure that they have diverse sources of contingency funding, and especially that they have the capacity to borrow at the discount window, and they periodically test this capacity. This includes considering establishing collateral pre-positioning requirements to facilitate borrowing from the discount window, improving the discount window's operational capacity, and enhancing coordination between the discount window and Federal Home Loan Banks. And we also need to support regulators' efforts to strengthen long-term debt requirements for regional banks so that they can be more effectively resolved if they do fail. Our understanding of the need for a holistic approach has also driven work on non-banks, which have become an increasingly important part of the U.S. financial system over the past few decades. Credit provided by U.S. non-bank intermediaries has been growing more quickly than bank credit. It now exceeds on-balance sheet bank credit. This makes non-banks an essential source of financing, with different segments of the sector supporting diverse activities from trading to retail. And this also means we need to focus on their vulnerabilities. Making sure FSOC has the tools it needs has been at the heart of our work. Last November, the Council took a key step forward by issuing updated guidance that establishes a transparent and durable process for how the Council uses its authority to designate a non-bank financial company for Fed supervision and prudential standards. This strengthens the Council's ability to promote a resilient financial system. But designation remains only one of FSOC's statutory authorities, and the non-bank sector is heterogeneous and diverse. So we've also pursued much broader work. We've made progress addressing investment funds with features that create financial vulnerabilities, such as through the SEC increasing liquidity requirements for money market mutual funds to reduce run risk. FSOC member agencies continue working to support better data collection and monitoring to identify risks from highly leveraged hedge funds and the growth in private credit. In other areas like open-end funds, the SEC and industry should continue to explore potential options to address remaining vulnerabilities. We've also focused on the increase in market share of non-bank mortgage servicers, which perform critical functions like collecting payments. FSOC, using its new analytic framework, issued a report finding that stress in this sector could harm mortgage borrowers and disrupt economic activity. Its recommendations include encouraging state regulators to strengthen prudential standards and require resolution and recovery planning, and calling for congressional action to establish a fund to facilitate continuity of servicing operations in the event of stress while avoiding taxpayer-funded bailouts. We've also identified new vulnerabilities related to newer entrants like fintechs and technological changes, including vulnerabilities presented by the significant growth of digital assets and trading platforms. Our work included issuing a report on digital assets and one on stablecoins, both of which assessed risks and called for Congress to legislate to close regulatory gaps while supporting innovation. And across banks and non-banks, we've also been focused on what I'll refer to as cross-cutting risks, including those related to cybersecurity, artificial intelligence, and climate. To combat cyber risks, we've helped lead a multi-year effort in collaboration with the private sector to bolster the safe and effective use of cloud services. We worked with banks to launch a cybersecurity alliance called Project Fortress. That's a public-private partnership through which we're joining forces with financial institutions of different sizes to deploy defensive measures like a tool that scans for vulnerabilities and offensive measures like sanctions to hold perpetrators of cyber-related activities accountable. AI could provide an advantage, at least initially, to cyber threat actors. So we've responded by providing a playbook for financial institutions on best practices for managing AI-specific cyber risks. More broadly, we also see that AI technologies bring significant potential for efficiency and other benefits, but also potential risks. We're working to monitor adoption, identify vulnerabilities, and assess whether existing regulations are sufficient to mitigate them or new ones are needed. We're focused on climate-related risks to financial stability as well. The Council's work to strengthen interagency coordination has been key, given gaps in data and fast-evolving risk assessment methodologies. The Office of Financial Research launched a cutting-edge platform that provides regulators access to climate and financial data to support more research and analysis. And we're currently collaborating with state insurance regulators to collect data on the cost and availability of homeowners insurance at the zip code level to help us better understand the risks to the financial system from increasingly severe and climate-related disasters. Addressing cyber, AI technologies, climate, and many other risks also requires applying another aspect of our approach, namely coordination and collaboration, including across jurisdictions. Risks don't respect national borders. The largest financial firms operate in many countries, and cross-border investor flows are sizable. This means we need to coordinate and communicate regularly with our counterparts in other countries and to engage through multilateral groups like the G7, the G20, and the Financial Stability Board. We got a powerful reminder of the importance of strong international coordination, and especially the need for a well-functioning international framework for recovery and resolution just last year with the failure of Credit Suisse. So we've made it a key priority to work closely with other jurisdictions before, during, and after times of financial stress. We've strengthened communication with counterparts in other jurisdictions, such as the EU, UK, and India, to understand each other's policies, clarify our intentions and expectations, and respond to crises. And financial stability has also been a key focus of our efforts to build a healthy economic relationship with China. The financial working group that Treasury launched and co-chairs with the People's Bank of China is now enabling regular and durable communication. And last month, we exchanged letters with the PBOC that strengthen information sharing and will make it easier to coordinate in times of financial stress. Well, I'll end here today having, I hope, given some indication of the breadth and depth of our recent and ongoing efforts. Work to build and maintain a resilient financial system is never over. We'll never be able to just declare victory, and successes can be hard to fully appreciate because they often entail having avoided counterfactuals. But that doesn't make them any less significant. We saw less than 2 decades ago how a financial crisis can turn the lives of millions of Americans upside down. And we saw only a year and a half ago that a government that keeps its eye on the ball can protect American businesses and households from financial contagion and its impacts. I could not believe more strongly that we must keep at it. A resilient financial system is critical to a strong economy, and strengthening it requires insisting on thoughtful regulation, including in the face of challenges from those who advocate to roll back policies and regulations. Well, it's been an honor for me to contribute to this ever-changing, ever-important project throughout my career and over the past 3.5 years as Treasury Secretary, and I'm proud of where we are today, even as we remain committed to the work ahead. Thanks so much for hearing me out.
Thank you, Secretary Yellen. It's my pleasure now to introduce our next speaker, Gary Gensler, Chair of the Securities and Exchange Commission, who will also be delivering keynote remarks. Mr. Gensler was sworn into the office of Chair of the SEC in 2021. Prior to his current position at the SEC, he served as Chair of the CFTC. He's also a Treasury alum, served as Assistant Secretary and Undersecretary of the Treasury, and has held a number of roles in private sector and academia. Please join me in welcoming Gary Gensler.
Thank you so much for the kind introduction, Brian. As is customary, the lawyers in the room will understand this. I have to note that my views, I'm speaking on behalf of myself in my role as chair of the SEC, but not on behalf of my commissioners or SEC staff. Now that's out of the way. I am really honored to be speaking here today following Secretary Yellen, under whose leadership we are in the midst of a significant reform of the U.S. Treasury markets. Now, I think back, she's 78th Secretary, but I think back to that first Treasury Secretary who kind of hung out around these parts down here, you know, Fraunces Tavern and some other spots. And I think Alexander Hamilton would tip his tricorn hat to you, his 77th successor, for focusing on the efficiency and resiliency of the U.S. Treasury markets. See, a couple hundred years before he became a Broadway star, in Hamilton. Maybe that's in your future too, Janet. But in 1790, Hamilton told Congress that, quote, the proper funding of the present debt will render it a national blessing. I think Hamilton's prophecy has turned out to be prescient. Treasuries are called the risk-free assets, of course, not just here in the U.S., but around the globe. They're the base upon which our entire capital market, so the $28 trillion at the base, is what our whole $120 trillion capital market is built upon. The U.S. Treasury markets also play an important role to the dollar's dominance. It's that risk-free asset that ensures that people can price and get in and out of dollars efficiently. They're, of course, how the government funds itself, how Janet and the Treasury Department funds the U.S. government, raise money to basically fund roads, bridges, public universities, our military, et cetera. We're the issuer and integral, of course, to the Federal Reserve's conduct to monetary policy. They're not using crypto. They're using treasuries. That's the base of this market. Given the magnitude, leverage, and importance of the treasury markets, as policymakers, we need to promote efficiency in the markets. Further, over the years, we've had jitters in these markets. That's what I will call it. You could call it other things, tremors, financial stability problems. In 2014, we had the flash rally. In the fall of 19, Treasury funding markets again experienced real problems. Secretary Yellen talked about what happened in early 2020 that you all know, and the dash for cash. We even had a little bit of jitters around that regional bank crisis 18 months or so ago. But it's not a new phenomenon. When I was early on Wall Street working over there at a building on Broad Street, I witnessed during my early days when a dozen government security dealers failed in the early 1980s. Given the magnitude, the leverage, and importance of the Treasury markets as policymakers, we can't ignore those tremors. So while clearinghouses do not eliminate all risk, I was glad to see earlier today it won the poll, that you all did a poll as to what was that reform under Secretary Yellen's leadership, what was that reform that was going to be most pro-resiliency, and it was central clearing. They facilitate what one might call the market plumbing. It's boring. You want it to be boring, but it's what happens after a transaction is executed. The clearinghouses do this, of course, by sitting in the middle, reducing the risk amongst the various counterparties, They also provide multilateral netting, so that lowers some of the capital that's needed in the system and helps lower the risk, of course. Central clearing also reduces risk through the robust rules of the clearinghouses themselves, collecting initial and variation margin and the like. So after the tremors in the 1980s, not the 78th Treasury Secretary, but the 65th Treasury Secretary, Jim Baker, worked with Congress to set up a federal regulatory regime for government securities dealers. You see, they were initially exempted. In 1934, they were exempted from the securities laws that were set up. There was no central clearing, but in 1986, Secretary Baker, working with Congress, saw a vision and also said that the Treasury dealers should be regulated either by the U.S. Treasury Department or the SEC, depending upon sort of their remit and so forth. Well, what happened a few weeks later? Some central clearing was set up. I would note it was on a transaction basis of T+1. And speaking of T+1, we successfully moved the whole U.S. equity markets and mortgages and everything else to T1 back in May, and we showed some leadership around the globe, and it moved smoothly for equities, corporate bonds, municipal securities. This was a win for investors. If you sell your stock on a Monday, you get your cash on a Tuesday. It's pretty simple, pretty straightforward. You don't have to wait till Wednesday anymore. Great pro-investor, but it's also pro-resiliency. And transitioning to T1 was also a team sport. Market participants around the globe, thousands and thousands of them, had to participate and come together. The SEC, the clearinghouses working together. By the way, we got Mexico and Canada joined us as well. Back to Treasury clearing. By 2022, only approximately 20% of the repo market was being centrally cleared. That's it. 30% of reverse repo. Further, the interdealer brokers that sit sort of as central hubs in this system often only brought one side of their trade in. If an interdealer broker failed today, sorry, John, you'd be cleaning up some of this. Michael Barr, I see here, too. Janet, hopefully you wouldn't have to, do some special thing under the law. But right now, they're not following clearinghouse rules, these interdealer brokers. There's a lot of risk in the system right there in those nodes. Thus, in December 23, the SEC adopted rules, working closely with the Federal Reserve, with the Treasury, with my colleagues from the CFTC, former colleagues, sorry, to facilitate central clearing. So what do we have in front of us? This team sport. In March of 25, the separation of house and customer margin must be completed. That ensures that the clearinghouse, when they're receiving margin from their members, the members can't mix proprietary trading with customer funds, separation. And there's forward motion on this. I saw the Trade Association, SIFMA, just yesterday finalized some documentation on standardized documents for the done with trades. They're still working on done away. I see Daryl Duffy. Daryl's going to want to make sure that done away is covered as well. And that will help more all-to-all trading as well. When posting margin, they no longer can commingle the margin. Further, I think it could enhance competition as broker-dealers will no longer be able to use their customer positions to lower the margin they're posting. So it's sort of like a pro-competitive thing as well. The market participants have experience with similar rules regarding gross margining and rehypothecation also in the swaps market, the options markets, the derivatives markets. Why not bring it to the Treasury market, these benefits as well? But I do think this so-called done-away trading, done-away transactions can be a very important component of the markets. I encourage market participants to continue to lean in to solve those issues. Now, to facilitate access to markets, it's important that the clearinghouses themselves and the clearing members promote an ability for market participants to trade anonymously. Anonymous trading in the markets promotes efficiency. It is competitive. It means dealers might have a little less advantage. But we're actually looking out for the issuers, and the issuer being the Treasury Department, and the investors in these markets. and to build that confidence of anonymous trading, so-called all-to-all trading, as well as promotes efficiency in this market. Subsequent to adopting the Treasury clearing rules, the Fixed Income Clearing Corporation filed proposed rule changes intended to meet these various requirements. I can't prejudge them. We're considering them. Right now, I think some of the first deadlines on that are in November, so all I can say is stay tuned. But the Commission has received numerous comments and continues to engage with market participants, like through this conference, and the Commission must approve it, I think, in November, as I said. More generally, we're monitoring various work streams, and please come in, dialogue with us on this. But these work streams and projects are too many to list, but it's about standard documentation like SIFMA did yesterday. It's about the appropriate accounting treatment. We oversee accounting for public companies, so we get a lot of questions about the netting of margin and how that works as well. It's about access models, possible cross-margining between Treasury cash positions and Treasury futures position. We're also monitoring development about additional methods by which registered investment companies will access central clearing. We're monitoring that there's at least two, not one, but two folks out there that are saying they might want to compete with FIC and offer central clearing. If they do apply, we'll put those out to public comment. We'll receive comment on their applications. Look, the final rules broaden the scope of transactions for clearing. Starting in the end of 2025, final rules mandate they require members to clear their cash trades. So that's pretty important. It's a certain narrower set of groups, but it includes those interdealer brokers, really fundamentally, and other dealers as well. But in June of 26, which is still what, let me think this out, it's about 21 months away, the final rules require clearinghouses to clear the repo trades. And that's a broader remit. That includes all the money market funds. By the way, money market funds are now $6.8 trillion. And money market funds invest in the Treasury markets significantly, multiple trillions. So it's been reported that there may be the new entrants I mentioned. It is estimated that volumes will increase a lot by June of 26. But let's talk about just history. Earlier this month, FIC announced that its yearly volume has already been up 42%. 42% already. On September 3rd, they set a new record, clearing $9.2 trillion in one day. So I think the market is moving in that direction, but of course the go live requirement is June of 26. Secretary Yellen mentioned it. We've also done work in terms of dealers, that dealers need to register if they're significant liquidity providers. I go back to the 1980s. I've been around long enough. There was a dozen of them that failed, and Congress in 1986 under Jim Baker said, no, well, Jim Baker was in the Treasury, but said, no, they need to register. Maybe we at the SEC hadn't done a good enough job to constantly remind people in the 90s and the noughts to register, so we did it through some rulemaking, and I think that's really important that we did that to get them inside the house and register as dealer as well. We've also done a lot of work with regard to exchanges and alternative trading systems. My predecessor, Jay Clayton, put out a proposal. We revised it. We put out a new proposal. We're still considering public comments with regard to these interdealer brokers and whether they need to register as alternative trading systems, provide fair access, have some systems compliance, and the like. I would note, and it was under Bob Rubin, the 70th Treasury Secretary. You see a theme. I don't think Bob, though, or Jim Baker played Candy Crush. But maybe Hamilton would be pretty impressed by your prowess on Candy Crush. You're still laughing, right? Let the audience know. All right, good. But it was at the dawn of the Internet when Bob was Treasury Secretary. Arthur Levitt had my role as the 25th SEC Chair. And under Arthur's leadership, in response to the new trading models, the SEC first set up a regulation called Regulation Alternative Trading System. And at the time, Treasury trading platforms were exempted from the regulations. That was a choice made in 1998. It may have been right in 98. I think in 2024, it's appropriate to, pull that in at this point in time. And if adopted, I think that proposal would have registration of these trading platforms. It would bring Treasury trading platforms within these important rules about regulation, systems compliance, and fair access. Secretary Yellen also mentioned transparency, and then I'm wrapping. I just want to say this, that earlier this year, we had a role as well. We approved the FINRA rules to have more transparency in this market. The FINRA rule, for the first time, will provide the public with post-trade transparency in the Treasury markets on a trade-by-trade basis. End of the day, in the corporate bond market, it's within 15 minutes. Actually, last week, the FINRA rule was to shorten that to 1 minute in the corporate bond, municipal bond markets over the MSRB. The Treasury market will be at least at the end of the day. And then we'll see in the future whether to maybe join the corporate bond markets and even do more. Post-trade transparency helps markets. It's a really important piece. Look, from Hamilton to Jim Baker to Bob Rubin to Janet Yellen. Is that a good crowd you're in? Each understood the importance of the U.S. Treasury market. Much has changed since Hamilton's era, obviously. We're not wearing tricorn hats any longer or anything like that. And he didn't see the dawn of the Internet. Hamilton didn't see it. He didn't see modern technology and how the electronic trading of markets are happening. $9 trillion a day being cleared in central clearing, or numbers that Hamilton, I think, couldn't have quite imagined. But I think that he would share Secretary Yellen's knack for trying to bring efficiency to this. And by the way, if he were alive today, he might compete with you on Candy Crush. He might. The challenge of our times is to bring reforms to ensure that these markets are efficient, that we continue to sort of support taxpayers through the funding of the government, support our monetary policy through the use of treasuries, support the dominance of the dollar, that this treasury market is so efficient. It's the base of our whole capital market. So I'm honored to be part of Team Yellen and getting this thing done. So thank you.
Thank you very much, Chair Gensler. And with that, we will move on to lunchtime. So lunch is downstairs in the Liberty Room, which is down on the first floor, same floor that most of you probably came in on. So you can head on out, and you should see guidance that will get you to the elevators and down to the first floor. And we will be back up here in a little over an hour for the afternoon festivities. Thanks, everyone. At this time, we're going to jump right into our next panel, which will focus on different approaches to Treasury market central clearing. We will reserve some time at the end of this panel for Q&A with the audience. For this discussion, I'll be handing things over to Michelle Neal, who will be moderating the panel. Michelle Neal is the head of markets here at the Federal Reserve Bank of New York. Over to you, Michelle.
Okay. Thanks, Brett, for that. It's a pleasure to be here with everybody at this 10th annual Treasury Markets Conference. In this panel, we are going to discuss some of the key issues surrounding the implementation of the SEC's central clearing rule. We'll start off by getting an overview of the rule. I know we've talked a little bit about it this morning, but we'll go in a little more depth about that, and the different sort of segments and products of the Treasury market that are affected. We'll then discuss the client access models that will be offered by the central counterparties and how the market structure could evolve in that regard. And then we'll round up with perspectives from market participants on what clearing access models are needed and how best to allow for trade execution and clearing services to be unbundled. There are obviously many other issues to grapple with as the market prepares for expanded central clearing, including gaining clarity on accounting treatment, various clearing options, standardizing legal documentation, and ironing these and other issues out will be important for the implementation, but not things that we'll touch on today, given the time that we have. So let me introduce our esteemed panelists. First, to my left, Elizabeth Fitzgerald is an assistant director in the Office of Clearance and Settlement at the SEC's Division of Trading and Markets, where she helps oversee the Commission's supervisory program for registered clearing agencies. Next, we have Laura Klimpel, who is a managing director and the head of fixed income and finance at DTCC, where she oversees the firm's Treasury, MBS, and secured funding products. Next, we have Suzanne Sprague, who serves as Senior Managing Director and Global Head of Clearing and Post-Trade Services at CME Group. She was previously a Managing Director at CME, managing different divisions of the clearing business. Next, we have Paul Hamill, who is a Senior Advisor to ICE. He was formerly the Global Head of Fixed Income Distribution for Citadel Securities, where he was responsible for the client-facing fixed income market-making businesses, including U.S. Treasuries. Then we have Lara Hernandez. We have this in the TMPG. We have Laura and Lara. And Lara is a managing director and head of fixed income sales and trading at Murray Asset Securities. And in that role, she is responsible for the firm's global fixed income financing business. And finally, we have Adam Nunes, who is the head of risk and compliance at Hudson River Trading, a multi-asset quantitative trading firm. And prior to joining Hudson River, Adam was Vice President of Transaction Services and Head of U.S. Options at NASDAQ. Okay. So let's now start our panel discussion. So I'm going to start with you, Elizabeth. Could you give us a brief overview of the clearing rule itself? I know we've heard from others this morning, including Chair Gensler, Secretary Yellen, who've talked about the importance of Treasury clearing to Treasury market resiliency going forward. But maybe you could expand a little bit further on some of the specific drivers behind the expansion of central clearing to Treasuries. Maybe talk a little bit about the segments and products and timing, and just bring us up to speed on some more of the details.
Sure. I think, like Chair Gensler, I'm obligated to start by pointing out that I am here in my personal capacity and not speaking on behalf of the Commission or the Division of Trading and Markets. But with that, I can get into it a bit. I'm happy to provide a bit of an overview. I think Chair Gensler covered some highlights already, so I'll try not to be too repetitive. And I think everyone in this room, I'd be very surprised if you didn't know that the Commission passed a rule, it's almost a year ago at this point, in December of 2023, with respect to central clearing in the Treasury market. I think, as you mentioned, Michelle, both Chair Gensler and Secretary Yellen highlighted the main purpose of that rule, which was to enhance and improve CCP risk management in the Treasury market. That's where I'm obviously at the Office of Clearance and Settlement. That's where our rubric is, and so that's really the lens that we brought to the rulemaking and what the rule is designed to improve from our perspective. It does that in, I would say, several different ways. The one that probably, well, maybe not on this panel actually, but one of the ones that gets talked about the most is with respect to a requirement to clear what's referred to as eligible secondary market transactions. That requirement is something that what the rule does, it puts a requirement on anyone in that central counterparty in the Treasury market. It's a membership requirement they have to put onto their direct members. And so if you're going to be a member of the clearinghouse, then you have to agree, the clearinghouse has to have policies and procedures in place to have you agree to clear what the eligible secondary market transactions are. Obviously, the rule defines what the eligible secondary market transactions are. They fall into three separate buckets, is how I think of them. The first is with respect to all repos and reverse repos, to which a direct participant is a counterparty. The second is with respect to cash purchases and sales between a direct participant and either a registered broker-dealer or a government securities broker or dealer. And then the third bucket is if you're a direct participant who is operating a trading facility that brings together buyers and sellers, and then when you're also taking a position in the middle between on the buyer side and the seller side. So that's the other set of trades that gets lumped in the cash side. There's also a number of exemptions. I don't think the chair touched on those, so I'm happy to just call them out in this context as well. There were a bunch in the proposing release with respect to things like natural persons, central banks, sovereign entities, things like that. And at adopting, we also expanded that list of exclusions or exemptions a bit to cover state and local governments, which is a defined term in the rule and has a very specific meaning. We also expanded it to include other clearing organizations as the counterparty. And then I think the last bucket is with respect to interaffiliate repo, and that's what's referred to, I think of as a conditional exemption. So if you are a direct participant who doesn't want to clear your interaffiliate repos, you can, to the extent that they are with certain types of affiliates, and also to the extent that the affiliate then clears its external-facing trades, those would then, you wouldn't have to clear the internal ones. But I think that's one bucket of what the rule did. I think another one that's worth talking about, particularly in this panel, is there was a rule, part of the rule that addressed access to clearing. And so what that does is require a clearing agency in the Treasury market to have policies and procedures in place to ensure appropriate access to its clearance and settlement services. And that's including with respect to indirect participants, folks who aren't obviously joining the clearinghouse directly. I think in the adopting release, the Commission talked about this a lot more, but an important thing to point out in this space, right, is it didn't particularly speak to how that access should occur, but really put an obligation on the CCP itself to think about how it's providing access and how it's meeting market needs, which is not something that was in our rule set previously. I think the last thing that I would flag from a risk management perspective, and the chair talked about this at length this morning, was the requirement that the clearinghouses separate house and customer margin, which is not something we previously had in our rule set either. So that's, I think, the overview of where we are. The only other thing that I thought was helpful to point out, particularly to this group, because so many of you are involved in it, is we've had an enormous amount of industry engagement and feedback on this proposal, or as well when it was a proposal and also since it was adopted. I think maybe as soon as a day or two after it was adopted was the first outreach we got with respect from the industry, and it continues every day since then over the past 10 months or so. I think it's both in the context of SRO rule filings, which I can touch on in a minute because I forgot timeframes, Michelle, sorry, but and then it also with respect to the rule in general. So we're really appreciative of that feedback, and I think it's really helping us think through a lot of the issues of implementation. So wanted to kind of say thanks for all of that and encourage folks to keep coming in with questions and challenges as they arise. I'll backtrack 1 second to talk about timelines. I think the chair touched on these this morning as well. They were sort of two phases. Everything with respect to, I think of it as the infrastructure parts of the rule, so everything except the clearing requirement had to have any SRO rule filings in earlier this year in March, and has to go into place by March, be like a compliance date where you turn the light switch on by end of March 2025. On the actual requirement piece, there was a requirement to file any rule filings in that regard by this past June of this year, then those dates flip on, as the chair mentioned, in December of 2025 on the cash side and June of 26 for the repo. So it's a little bit, I have a matrix in my head, it's a little bit hard to keep track of, but I think hopefully that situates us well for a productive discussion.
Okay, well, that's very helpful. Thank you so much. So one issue that's been actively discussed is client clearing access models that will be needed to facilitate this large increase in clearing capacity across the market. So in other markets, like futures or cleared OTC derivatives, it's typical that client trade execution and clearing services are provided on an unbundled basis, meaning you can execute with one market participant and then you can clear through another. And that practice is known as done-away clearing. And I think we touched on it, maybe it was mentioned once or twice this morning. So when the clearing trade is executed away from the clearing firm. Obviously in the U.S. Treasury market, done with is the current prevalent model, where the trade counterparty also clears the trade. And some observers, observe that it's in order to have a viable clearing market, we'll need to have this done away option for Treasury clearing to be expanded as the rule requires. So, Lara, can you explain a little bit the impact that the prevalence of done with clearing has on Treasury market trading, and maybe what are some of the issues that emerge around that as a result?
Sure, Michelle. So the prevalence of done with clearing really is to promote liquidity in the marketplace, ensure that the market remains stable, and also to reduce counterparty risk. Now, some of the issues that I see emerging with the new models is that the vendors that are responsible for a large technology portion of this, I don't think are fully prepared yet. I know that from our own experience, we just recently became a sponsoring firm, and it took our vendor about a year to get the coding and everything done, and it's still not 100%. So leading into now, we're just actually looking at ACM. So we just started to reach out to FICC and get those docs. I think there needs to be a little bit of some oversight. I don't know if it would be from the SEC or the FICC, but that the vendors would need some help also to ensure that they can meet the timelines that are out there. So that's one issue that I see. The other issue that I do see is how the counterparties are going to transact. I commend Laura and team and Suzanne that they're working together to get FCM netting, which is going to be very attractive, where the hedge fund community, who plays a large role in supporting the Treasury market, will be able to net their Treasury transactions versus their futures. This I think I could see a large portion of the market going to, because now they're going to get up to 80% netting benefit. That poses an issue for dealers like the mid-sized dealers like Murray, because we're not an FCM. So there's about 60 FCMs out there. Not all of them will offer repo or a Treasury clearing, but I'd say probably 6 to 10 are more likely the amount that do currently offer both products. And so Murray went down exploring how can we now keep our counterparty base and still keep our business viable. So it's a heavy lift to become an FCM. We were willing to do so. However, the feedback that we got back from our counterparty base is that although they love to have 30 to 35 Treasury and repo counterparties, they can't really handle operationally more than 2 to 3 FCMs. So what do I see? What does that lead to? It increases concentration risk again now, because now you're going to have the hedge fund community going to 6 large dealers to do, say, I don't know, let's say 75% of their business, because they're not going to do everything. They want some kind of diversification, but I could see a large portion of the market shifting to the larger dealers who can offer this netting.
Yep, a lot of issues in the structure of that. Maybe we could turn to Laura Klimpel for a moment, and just maybe in response to the rule, we know that FICC has been submitting many filings in relation to that. Among other things, clearing access models are part of those documentations that will kind of outline what you need to meet the rule requirements. Could you maybe talk about the different client access models that you will be offering, and really, I guess, inherent in that, to kind of touch on kind of how that will impact the provision of done-away trading?
Thanks, Michelle, and thanks for having me here today. When we think about access models in FICC, I think before we jump into client clearing, I want to draw a distinction between direct and indirect access. So we have direct access models, most predominantly becoming a direct full-service netting member of the Government Securities Division of FICC. And I flag this because this is a choice, this is an option for asset managers if they are willing, and some have decided that they are, and it makes business sense for them to set up a regulated entity, either a broker-dealer or an FCM or a bank, to become a direct member of FICC. If they do that, and I have at least 4 levered asset managers off the top of my head that I know have done that and have direct access to FICC as a netting member, the issue of done away is a non-issue, right? Because they can transact with whoever they want in clearing without impediment of needing to go through an intermediary. So direct access is a choice. There's costs and benefits. Each firm is going to make different decisions on it, but I want to flag that as an option too. Then when we think about indirect access, by definition, that's coming through an intermediary. We have 2 models for indirect access. The first is the sponsored service, so that is where the underlying client becomes a limited direct member of the CCP, and the sponsoring member acts as its clearing intermediary and as its guarantor. That's one model. We also have an agent clearing service, or ACS, which represents a consolidation of our historical prime brokerage and correspondent clearing services, and has been in that model, which most folks generally tend to be less familiar with unless you are an incumbent prime broker or correspondent clearer that uses the service. This model is really built for done-away activity, and we've had tens of billions of dollars of cash activity flowing through that product for many years. One of the things that we did in response to the SEC rule and in response to the requirement that we create access models or enhance our access models to ensure reasonable access for all market participants is we took that ACS model and updated the language of the rule to make it track almost identically to what an FCM rulebook would look like. So it's really that those rule changes that we made were really proposed rule changes were intended to give familiarity to the intermediaries like the FCMs who are used to certain rules being in the rule book of a CCP for that type of activity, and to market participants that are used to clearing in an agency-style model, that ACS service was usable by them and should be very closely aligned to what they're used to in other clearinghouses' rule books that clear in the derivative space. And I would just note that we got some great feedback on our access model filing, and I'm expecting us to incorporate a lot of that feedback in the ultimate rule subject to approval by the SEC. So please keep giving us feedback on access models. We really appreciate it, and we want to make sure that our models are fit for purpose for all market participants to come in. I would note, this is important, that both our agency clearing service and our sponsored service facilitate done-away activity as well as done-with activity. Both models do both. So there's really not a distinction in terms of the ability to execute either away or with your clearing member in both models. Also, both models will allow, as Elizabeth mentioned, for customers, if they choose to post margin, to have that margin held in segregation at the clearinghouse. So both have segregated margin options, both have done-away options. And I just want to point out, in terms of when we think about the future of clearing, I think, and sort of how do we get from here to the clearing mandate, Chair Gensler made a point to note that we actually hit an all-time high in the government securities division of $9.2 trillion on September 3rd of this year. Just to show you the trend line, when the SEC rule was proposed in 2022, we were at $4.5 trillion. So we have more than doubled the activity that is coming into the government securities division, and a lot of that is buy-side activity. We also hit a sponsored high in our sponsored service last night of $1.5 trillion. So that is a new high for us, and we created, through that activity, novating activity, $662 billion of balance sheet savings yesterday. So I think really the point here is that the access models and the diversity of access models is really valuable to the community, and it's creating value in terms of the efficiencies, the balance sheet efficiencies and so forth that novation to the CCP creates. When we talk about done-away specifically, to the last part of your question, I think it's important to orient the conversation that the rule book of the CCP is critical, right, in being able to articulate what the terms are going to be of done-away clearing. But there are other areas of focus that need to be bottomed out in order for done-away clearing to proliferate beyond what it is today in FICC. And the first one we've talked about a couple times, which is accounting. So this is sort of, I would say, a sleeper issue that really sort of bubbled up in the last couple of months, which is that while the accounting treatment of done-away style activity in the derivative space, has been vetted for several years, and sort of agented treatment of that activity and off-sheet recognition of that activity has been recognized for several years. This is a new exercise for the accountants, right? They need to look at this model as it relates to the Treasury clearing market specifically, even though we have modeled our rulebook very closely on the FCM space. It is still a new accounting analysis. We are working very closely with the accounting community, who we know is very focused on this issue, and particularly the done-away aspects of ACS. So I think bottoming out the accounting is critical. Why is it critical? Because the capital treatment that the intermediary needs to be able to take is what is going to make the facilitation through done-away viable. If they can't take capital relief for being able to recognize the activity as agented off-sheet, they're not going to be able to do it. So the accounting is really the key decision for capital treatment, which is going to be able to, from my perspective, make it economically viable or not to offer done-away. The second topic, which we haven't really covered yet, is workflow. So we've been in active discussions, and I see some of the folks in the audience who we've been working very closely with at FIA and at SIFMA on what is the workflow that an intermediary that's going to facilitate Dunaway in this space is going to expect, right? And what we have learned is that the FCM community, just like they get in the swaps execution space, is going to expect a pre-novation credit check. So they're not going to accept the responsibility for a trade and with the CCP, against the CCP, unless they're able to do at some point, north of the CCP, a check to make sure that they have a sufficient limit for that particular client. So I would say, at least for the cleared market in Treasury space, this is new. This is a new workflow. So there will be questions about, is that credit check going to happen pre-trade? Is it going to happen? Will they let it happen post-trade? What happens if the credit check fails and the trade needs to be submitted for clearing? So there's a lot of decision, who will provide the credit check and who will be the platforms that support this workflow. So I think there's a lot of discussion that still needs to happen within the industry about how they would like to see the sort of FCM workflow work in the Treasury space. We've been working very closely with FIA and with SIFMA and have, developed strawman workflows that we would recommend as a starting point, at least for the conversation. And we stand ready to support that workflow, when it comes to fruition. But I think it's key. And back to the documentation, the workflow is going to inform the documentation. The lawyers don't know what to write, right, until the workflow gets worked out and these key decisions about how it's going to work get agreed to, as between the sell side, the buy side, and the platforms.
Yeah, and I think in the OTC markets, they solved that with sort of compensation agreements that allowed trades to be effectively torn up if they actually didn't ultimately get novated. That's
going to be a question, right? Is that going to be an outcome here, or will the trade go bilateral? How will that be impacted by the clearing requirement, et cetera? So I think there's a lot to work out in that space still, beyond the CCP's rulebook.
So there's a lot of wood to chop still. But, well, Suzanne, CME is no stranger to clearing and big clearing businesses, and you've now stated your intention to move into the Treasury market and provide services. Maybe talk to us a little bit about what CME plans to do, and maybe what you see as sort of the differentiator kind of to the service you guys would offer.
Yeah, sure. Thanks for having me here today. So I'll just expand a little bit on a point that Laura mentioned earlier to emphasize the efficiencies that can be gained from cross-margining in the space. And so that is a primary focus for us in partnership with the FICC in being able to take what is now an enhanced cross-margining program that we were able to launch in January of this year that has gotten good traction for clearing member house accounts and expand that to customers. So I'll just start by acknowledging some of the common themes that we're starting to hear about on this panel today, really being focused on costs and capital efficiencies to be able to support the clearing mandate and the increased demands that come from that. And that we are working closely with FIC on being able to bring to market that cross-margining solution to customers consistent with the timing of the clearing mandate, obviously subject to regulatory approval as well. In addition to that, CME is applying to be a securities clearing agency as well. So we've been working with the SEC on that process ourselves to be able to bring to market a solution that will also support done with and done away activity, recognizing the role that we play in the interest rate space today and wanting to be able to continue to support efficiencies where they make sense in the future. So in our structure, the details are still being sorted out through the application process with the SEC, but it's our intention to be able to offer a client access model that would be balance sheet friendly and support both done with and done away activity. So we are excited to be able to both partner and think about the efficiencies that we can offer more broadly in the interest rate space as a clearinghouse that focuses on that activity today for futures, options, and swaps. But we are engaged in that process with the SEC and the marketplace to be able to refine the details.
Thank you. Paul, similar question. I mean, ICE has a slightly different DNA in terms of its clearing offering, obviously prevalent in credit markets, and now you've also sort of declared an intention to kind of move into the Treasury space as well. So maybe kind of give us a similar overview of what are you planning to offer, what product segments, and how does that kind of fit your offering, and what kind of value is that going to bring to the marketplace?
Sure. Thanks for having me. I probably wouldn't see ICE as a slightly different DNA. ICE operates 6 clearinghouses globally. ICE Clear Credit is the one for credit default swaps. It's really the current solution in U.S. Treasuries that has a different DNA. Most other clearing all looks the same. Futures, swaps, energy, all clear generally the same way. The concept of done with and done away in these slightly overcomplicated terms don't exist in other markets because there really only is done away. That's just how the world works. So the way that ICE is approaching this is to look at the problems that in relatively recent history we solved for swaps. All the same market participants, all the same initial problems, all the same challenges we're throwing up around how we're going to do this. And in the end, with everyone's involvement and participation, ICE and others developed some of the gold standard for clearing, the best solutions that are still in use today. There was early competition. ICE now has close to 100% market share in credit, and there's a reason for that. But most important, I think, is stepping back and saying, what should clearing deliver for the market, right? Right now, the market is deep in the weeds of trying to solve how do you make FICC clearing work. What we need to do is stop and think about what does clearing need to look like? What can we do to unleash potential, increase resiliency, and increase transparency? It looks an awful lot like what we did for swaps, right? And you start with the unbundling of clearing and execution. That just is how clearing should work. Customers should have the ability to choose a price for the product and then shop around for a price for the clearing services provided by an FCM or a clearing broker. Trades, just like any other clearinghouse, could be brought direct or through a clearing broker / FCM. We think that's how most trades will work. But there's a couple of really important things that happened with swaps. And they may not happen here because the rules are much less specific. And the CFTC rules, in fact, being so specific, helped set a very high standard for how clearing should work. A key component is the immediacy of clearing and the elimination of counterparty credit risk. We don't really hear a lot of talk so far about the elimination of counterparty credit risk. That should be a must-have for clearing. Like, if you're going to introduce a new counterparty, it can't be another counterparty. It should be the counterparty. So we are focused on delivering exactly that same high standard that was delivered for swaps to the Treasury market. In the swap market, as you may know, trades are considered instantaneously cleared. Bilateral counterparty credit risk is considered non-existent. Complex, lengthy documentation required to onboard counterparties is no longer required. That worked really well for the market. That also, if you unbundle the execution piece, unbundle the clearing piece, and get immediate clearing, you unlock potential for more liquidity and more access to liquidity. Some people call that all-to-all. All-to-all doesn't usually happen on the first day, but if I now live in a world where I can trade the product and I can trade with whomever I want on whatever venue I want and instantaneously give it up for clearing, I now by definition have access to more liquidity and more counterparties. That, again, has not really been a key topic here so far. We're pretty confident it will become a key topic because if we look at what became key topics when we were implementing swaps clearing, this was one of them. Once you get access to all-to-all trading, you start to see potential and innovation on the trading platforms. You see new counterparties. I went to Citadel Securities and built an entire swap business on the back of the Dodd-Frank rules and those particular components of the elimination of counterparty credit risk. Segregation of collateral, LSOC-style segregation of collateral is critical. We don't hear a lot of conversation about that yet today. We're going to hear more because fully segregated collateral is a key component of porting positions in the event of a default or prior to a default. We don't talk a lot about porting, but yet that was one of the most important topics in swap implementation. We expect it will become one here too. This year, this surprised me when I got the statistic, this year ICE has ported more than 7,000 portfolios between different clearing FCMs in peacetime. So this is not a tool that's just built for default. It's a tool that's built in peacetime so customers can choose better pricing and better options and switch out their FCMs or clearing brokers. But for all that to work, you have to start with a very simple framework. There's clearing brokers that bring in trades. Execution is separate. Trades are immediately cleared. Collateral is fully segregated, and it is portable in peacetime and in wartime. If you wrap around all that, the various components of transparency and reporting, that ICE has built through its ICE Link platform in response to market demand, we think we've got the best solution. ICE is the only clearinghouse which is a registered and regulated DCO of the CFTC and licensed regulated clearinghouse at the SEC today, the only one, and a SIFI. So there's a lot of logic that might not be incredibly obvious to everyone given the credit component of the DNA. But if you step back and look at the structure of what is the best clearing outcome for markets and what is the best foundation to build the next 30 years of the Treasury market, it's going to look a lot like what we did for swaps. And we believe the market will gravitate towards that type of solution.
That's very helpful. Thanks. So obviously we've just talked a little bit about the fact that we're likely going to end up in a multi-CCP landscape. You've just talked about some of the advantages of that. Obviously, we're starting from the point where FICC is the current and only central counterparty. But maybe, given you've just focused on some of the pros of a multi-CCP landscape, can you think about some of the maybe disadvantages or challenges? And maybe we could hear from each of you, Paul, Suzanne, Laura, but maybe just start with you, Paul.
I mean, short term, there is going to be some friction, right? We saw this in swaps, we saw the LCH-CME basis, we've seen these things before. But, just because you got to choose between like Hulu, Netflix, and Prime, it doesn't mean you want to go back to cable TV, right? Like it comes at a price, competition. What we see is that competition is very, very healthy because it challenges the clearinghouses to be more innovative, right? Around the solutions, whether it's risk, whether it's operational, access, models, et cetera. But really, in this case, competition is critical for a couple of reasons. One, the current solution in the market is deeply unpopular with investors, right? There is a deficit of trust that solution will be ready and scalable for the entire Treasury market in the timeline that we're talking about. And then the other component is because the rules are less clear. So in swaps, when the clearinghouses were implemented, it was three competing clearinghouses, let's say, but the structure was the same. Everyone was competing for the same thing. Here, because the rules are less clear, you have fixed style solutions which are not the same as ICE. So not only do we need competition just for the commercial element of it, we need competition because there's different ways to clear here in this market. And clearly people need the choice, or at least we believe, and I think most market participants believe, you need to have a choice that looks like traditional clearing that brought all the benefits that it brought to swaps, futures, other liquid cleared markets. Like we believe that is why the competition needs to exist.
Want to comment on that?
Yeah, I'll just add that I think cost is a focus, obviously, in any decisions that market participants are making. And there are a few recent surveys that have come across and highlighted cost and capacity or increased volume as being the top two elements to consider with the clearing mandate itself. And so being able to make that decision of what cost allocation makes sense for you will be a very individual decision, I think. Being able to evaluate the choices in the marketplace will come largely into play when you think about balancing capacity, cost, and resilience. So I don't know that it will be a straight pro or con necessarily for everyone on a black and white face of it, but I think that being able to have the information to make the decision is complex, and Laura touched a little bit on the accounting treatment element of it. That will drive individual decisions largely as well, depending on the type of participant you are and the implications to balance sheet and other costs associated with doing business. So I don't know that it's as straightforward necessarily as just a pro or a con, but I think information is key, and so being able to have the information that makes sense, as well as opinions or analysis to support the implications of the balance sheet or accounting treatment relative to the nature of your business will be key. And so I know there is a lot of focus in the industry in discussing that and trying to bring forward analysis to help in that decision-making process. And hopefully that will be able to be produced in the next few months.
We look forward to competing. But it doesn't really change what FICC is focused on and our mission to lead this market safely and efficiently through this transformation. And whether a competitor ultimately emerges, or more than one ultimately emerges to FICC or not, we're going to be laser focused on our mission, and we're going to continue to innovate, as we have done for many years, in rolling out new products that create new value for our clients, whether that be through capital efficiencies, through margining efficiencies such as cross-margining, through new service innovations. We're going to continue to stay the course, and we look forward to market participants having a choice, and we think it will be us.
Okay, spicy. Thank you for all putting your best foot forward. That was excellent. But it would actually be, I think, actually helpful to hear from maybe Adam and also Lara a little bit how you going to see a multi-CCP landscape and how you might sort of navigate that. Maybe talk about some of the decisioning around that from your perspective.
Yeah, I guess to start, the concept of moving to clearing makes sense. I think what Paul says is what we see around the world. But we're at a point where, treasuries are different than swaps. Like swaps are derivatives, they don't hit the balance sheet. Treasuries have a huge balance sheet impact with a much smaller risk impact. But credit is a balance sheet issue. So I think where we stand right now, I just kind of love what I hear because I think this is all about implementation and getting the diversity of ideas, at this stage to find the best model, I think is pretty critical. When we look ahead at actually operating in that world, it's a little less exciting. But I think we have to understand, we could have a situation where we have different clearinghouses that are, better at certain trades. Like if you get a futures offset, that's great. Not every treasuries trade has a future offsetting it, so there may be another model that works great for those. And then just thinking about the complexity, Paul referenced it, but, we're a significant liquidity provider. We're not exactly looking forward to here's our price for ICE, and here's our price for CME, and here's our price for FIC, and just having 3 prices for everything or a basis around that. But we have to kind of see how it plays out, see if, there are niches where certain trades make sense and niches where other trades do, and maybe those will be natural. Or, there's a version of the world where it's winner takes all, and, it's kind of, there's not just like TV, and you just turn on the TV and you use the channel, right? So, we do.
Still better.
We do. Well, that's great, but the programming wouldn't be that great. So we kind of generally on the cost side, seeing that competition, will work. But, there's a other side to that coin, and it's going to be complexity.
I think they touched on a lot of points that I was going to touch on, but I will say that I do think that competition in any market is healthy. I think we have to see what the other offerings are going to be, and it's going to be each firm to make a decision which route they want to go down, or if they want to do multiple routes. It's what's going to benefit each dealer per se, and is the cost going to outweigh the benefits?
Okay, thanks. Well, sticking with you for a minute, Lara.
Sure.
From the perspective of a mid-sized dealer like Murray, maybe talk a little bit about some of the barriers that smaller dealers face with actually being able to offer sponsored repo to their customers. And so if you're not able to offer sponsored repo, it will be important for this Dunaway model to come to fruition, obviously sharpish. So could you talk to us a little bit about what you think that needs to look like from your perspective, so that, obviously your franchise from a client standpoint, continues to endure. But I think, maybe start with the sponsored repo offering and kind of some of the hurdles and barriers around that.
Kind of a two-part answer with the sponsored repo. So just to give the audience kind of a brief overview of how FICC calculates the clearing fund requirement in sponsored. Each sponsored member receives their own VAR for their portfolio. So there's no netting benefit. It's all gross margining. There is a rule called ECP, or excess capital premium, where if a broker-dealer has less than $5 billion of capital, they can be charged with excess capital premium. It's a clearing fund component if the aggregate of all the sponsored members' VARs exceed your net capital. once it exceeds net capital by $1, it exponentially grows. So this is a large challenge for the smaller dealer community. I think that one way in the new offering that we can get around that is that now with the new 15C3 SEG accounts option coming into play, we will have to charge the client's margin. They post the margin, it goes to the FICC. That then offsets their individual VAR requirement, and then the dealer doesn't hit excess capital premium. Now, the second part of that is the challenge there is that there are a lot of dealers that do offer sponsored repo and don't charge any haircuts. So that makes it harder for us because then we become less competitive. As far as Dunaway, Dunaway is challenging right now. I think that's a hot topic, and everyone's trying to figure out how and who's going to offer it. To date, no dealers have come out and said, I'm going to do Dunaway, offer Dunaway repo. And I think the challenge is the accounting side, the legal liability of why would you allow a customer to do a transaction away from you where you're legally liable for and you have no economic benefit. There's some, it's called a tri-party. There's some prime brokers out there that do offer something called a tri-party agreement. It's a netting agreement where if you have a client that does the futures transactions with you, but yet they might have a second prime broker that they also do treasury transactions for, that the two dealers, the prime broker for the FCM and the prime broker for the treasury transactions, they have a netting, basically like a master netting agreement, where should that client default, someone's sitting with the excess, somebody's sitting with the deficit, and they can offset each other. So that's one way that I think in the future, it's not very common right now, but I think that that's one way Dunaway repo could become more common.
Thank you. Adam, one for you. So as Elizabeth mentioned earlier, it was also touched on by Chair Gensler in his remarks, the segment of the market around interdealer brokers. Firms like yours, proprietary trading firms, obviously make use of IDB platforms pretty significantly for execution. I guess that by definition will require access models that allow people to give up the trades to the clearinghouse who are not involved in the execution. Maybe you can talk a little bit about, from your perspective and from the PTF perspective specifically, how do you think that's going to move forward? What does the access model need to look like for that workflow? Would you expect to modify the way you execute depending on how things develop?
Sure. So I guess I'll give a little context to Hudson River Trading. So we're a principal trading firm. We make markets on the ECNs. We make markets bilaterally to counterparties. We also have a business that's more a quant macro business that's much more hedge fund and buy side looking. So we kind of see this from both sides. But even in our market making business, we still care about repo, and I feel like repo is kind of rightfully the thing that everyone's talking about, because I think cash at least has a path forward. I don't think it's settled that that's going to go great. But my expectation is that we're going to, in today's world, a lot of the ECN activity is done via Fedwire. And there are firms who offer clearing services and other assets that are effectively settlement agents for Fedwire transactions. And I kind of expect to see those firms move in and offer access to clearing for cash. I think there are some questions. They're not big banks. There may be capacity issues there, but the rehypothecation should help with that. And I think the agent model that Lara described is likely, it's not settled yet, but likely the model that we see emerge there. And you have to remember, cash, you trade it, it settles the next day. It's not sitting on a balance sheet. It doesn't persist in the same way repo does, so it just doesn't raise a lot of those same issues. But as you referenced, every cash trade on an ECN is a Dunaway trade. You are trading, your counterparty is a broker-dealer that is operating the IDB. Your actual trading counterparty is another counterparty who's facing off with the IDB. So when you talk about things like the credit hub that was referenced earlier, These are like high turnover, low latency platforms that operate similar to the stock market. The notion that you're going to ping a credit hub in the path of a match is just kind of like, it's not going to be the case. And to be fair, it's not the case in stocks. It's not the case in futures. It's not the case in options. Like, those are solved problems, and there's no reason we can't solve them in this context. So I kind of see there's a path forward there. There are some like potential hurdles in the road. But, even for our market making side of the business, we facilitate that book we facilitate our market making by having a book. We need access to repo. So I think when we look at it, we see some of the, current settlement agents as an option to move into that space. I think that, there are a few that are like doing that. But we need enough capacity there to make that work. And then I think in the PTF community, there's a handful of firms that have the middle office, back office to become a FIC member. You might run into issues on fewer of them are CME members. But, so you may give up some offset to do that if there are trade-offs and people are going to figure out those trade-offs and try to get it right. But most PTFs just use a third-party clearing firm for everything. And, it kind of works the way Paul discussed, and I think the more that they can see that as an option, the more we're going to continue to see that liquidity in the market.
Thank you. We've got a few minutes left, and so we wanted to turn to audience questions, if there are any, before we have a final question for the panel. This over here.
Hi, Sam Hempel from the Federal Reserve Board. I wanted to get your perspectives, I guess for anyone on the panel, on potential challenges to repos and central clearing, and your thoughts to the extent to which people might try to sort of get out of it a bit by doing it slightly different, like, I'm going to put some optionality on, and well, this optionality is not eligible, so boom, now I can put it on central cleared, or maybe even a little bit more out there, like, it's not a repo, it's a sec lending collateralized by cash, and now it's not eligible for central clearing anymore. How much do you worry about this going forward, or is this like, let's just all get on board with central clearing, it's where the train's going, how do you think about that? Thank you.
I can take a crack at that first, just thinking about what we saw. I mean, everyone talked about that in swaps, right? And the reality is most people don't understand that evading the spirit of a rule is not what you're supposed to do. So typically you do not find firms spending a lot of brain power trying to figure out how to avoid the rules. It's all about liquidity, though. So, you could have chosen after the implementation of swaps to just trade a forward-starting swap or some sort of slightly off-market swap, but you pay a premium for the less liquid product. So, I think in reality, the liquidity still is where it is, and that is what people are going to be focused on, maintaining their access to liquidity. If you talk to anyone about what they're concerned about in repo generally, it is just liquidity. Will my liquidity still be there? And it was notable that you heard someone say that by allowing the bundling and the sponsored access to continue to exist, by not having the equivalent business conduct rule that we had in swaps that forced that unbundling, you're going to create a two-tier market. People who today compete in that market will still be able to compete, but they'll be competing at a higher cost relative to a concentrated group of large small group of sponsored access providing big dealers. That doesn't seem like the right outcome for the repo market, considering what we were trying to solve was increased liquidity. So my guess is we're not done yet on the conversation around bundling and unbundling, because it feels too important to just breeze past it and let the market evolve to a place where there's two tracks. I would say that's what most people are concerned about, is I want to still make sure the liquidity is there. Much less focus from the people I talk to about evasive types of tactics.
Got another question? First, just here in the middle. No, down here. Sorry.
Samim Gamami from the SEC. Should I continue? Yeah, okay. So you mentioned the importance of eliminating counterparty credit risk. I was wondering if you can give an example of eliminating counterparty credit risk in a default scenario under, for example, the agent access model for a done-away trade. Thank you.
Well, the elimination of counterparty credit risk happens, if you think about, we saw a couple of things in the CFTC rules. One was the void ab initio concept, making the trade void if it didn't clear almost instantaneously. There was an initial mandate to clear as soon as technologically practicable, which forced everyone towards the focal point of clearing trades in an instantaneous basis. Then you have a relatively simple document, a CDEA in this case, which deals with the very rare situation where a trade might not clear. In this case, the way I would look at the rules, the requirement is to submit the trade for clearing, not necessarily to clear it. So I don't even think we have a problem if a trade doesn't clear. But the elimination of counterparty credit risk happens right up front at the point of execution, where you execute and get the trade into clearing. Now, clearly, there is a period of time. It's not like zero. But if it's almost zero, what we learned in swaps is almost zero is perceived to be zero. And therefore, counterparty credit risk is perceived to not exist. It is still governed by a very light touch framework that does, as I say, deal with the case, but that's what I would expect to happen.
Anybody else?
I'm Claire Noon from the Reserve Bank of Australia. So as a central bank, we're part of the group that is exempt. And so one of the things we're thinking about is what, once this is all implemented, what does that market for non-centrally cleared repos look like? What is the volume? What does liquidity look like? What does pricing look like? And so I was interested in if any of you, for you to look into your crystal ball about what you think is most likely. Is that market going to continue to be reasonably large, or do you expect some migration voluntarily into central clearing?
I'll take it. I think right now the non-centrally cleared market represents roughly 70% of the market, and after all is said and done, June 2026 or maybe later, I think that we'll probably still see about 20 to 25% of the market will still be non-centrally cleared, just for the simple fact that was previously mentioned that there are certain counterparties that do open transactions for a number of reasons. A, it reduces costs for ticket fees. B, it gives them the optionality of the flexibility of not being locked into term trading. And then you still have evergreen structures and floaters. And then I guess I can hand it over to Laura and say, unless you think that the FICC is going to come up with a model to capture that, then I'll say that the answer will be less than 20 to 25%.
I might. But also, central banks are not prohibited from clearing, and you would be in good company if you were considering a cleared repo as an option for your investment, because I suspect it will ultimately impact pricing.
Okay, I think we need to wrap it up. So thank you for the audience questions. I was going to ask a yes or no question, but I think I know the answer to it actually. So you can just tell me maybe if you don't agree. So a recent study by Coalition Greenwich on the impact of the SEC's clearing rule found that over 60% of firms surveyed thought that the rule would increase market resiliency. Our earlier phone survey indicated sort of similar results. I don't remember exactly what the proportion was, but that was clear. So rather than ask each of you to respond, does anyone think that it doesn't add resiliency to the market? Right. Okay. That's what I thought. I was going to skip that, but I thought that it was good to tie it up with the survey results from two different surveys, and it was interesting to see that they're very consistent. So thank you to our panelists, and we'll close it out here.
Thank you, Michelle, and thank you to all of our panelists for that excellent discussion and some good Q&A at the end. Prior to our next two people up here, we are going to run another Slido poll, which I see has already popped up here, so please get your devices out, your personal or work device, slido.com, and much simpler set of answers this time. Do you think the Treasury market would be best served by a single CCP or multiple CCPs? All right, I think the results appear pretty resounding, but I still need to stall a little bit for some redecorating down here. But nonetheless, looks like about 3/4 of the people think multiple CCPs, so I guess Laura will be very excited about that opportunity that you'll have. So, okay, I think we're ready to move forward, and at this time, my pleasure to introduce Rostin Benham, Chairman of the U.S. Commodity Futures Trading Commission, who will be participating in a moderated discussion with Jackie Mesa. Chairman Benham was sworn in as the CFTC Chairman in January of 2022 and had originally joined the CFTC as a commissioner in 2017. At the CFTC, he has focused on prioritizing customer protections, examining potential systemic market risks, the global transfer away from LIBOR, again, and risks that climate change pose to the financial markets. In addition, he spearheaded the effort to establish the CFTC's Market Risk Advisory Committee's Climate-Related Market Risk Subcommittee. I feel like I needed an acronym for that one. But welcome. Joining Chairman Benham today is Jackie Mesa. Ms. Mesa is the Chief Operating Officer and Senior Vice President of the Futures Industry Association, where she helps develop, implement, and manage FIA's global regulatory, government relations, and policy agenda. Prior to her role at the FIA, Ms. Mesa served in various positions at the CFTC, including as Director of the Office of International Affairs. We will reserve some time for Q&A from the audience after the discussion, so I'll turn it over to you. Thank you.
Wonderful. Well, thank you, Chairman Benham, for being with us today. I know you're also here for Climate Week, so maybe if we have some time, we'll talk about that. But I do want to just start with your primary oversight role as the overseer of Treasury futures. There was a panel, the first panel to kick us off today, about Treasury futures and what's happening in the futures, particularly from the asset manager's perspective. Who's in it? We actually just had this slide of your data, which your data is vast, and I think show the growth of the Treasury futures market right here. But I want to ask you about participation more broadly. What do you see happening in the Treasury futures market? Who are the participants? What are the segments?
Jackie, thank you. It's great to have the conversation with you. I also want to thank President Williams and the invitation to be back here. This is an important chart, and I think and we put it up last year when I gave a speech, and I think a huge theme of last year's conversation was the basis trade, and it's a big issue for the Secretary and others at both the Treasury Department and the Fed. And I think, if I recall, the theme of the speech, or at least a message, was we're seeing pretty tight correlation between the growth of the futures market as it relates to the actual cash market. Obviously, we've seen a huge growth in the cash market for a number of reasons since COVID, and some fiscal policy as well, but that basis trade has grown. We observe and surveil the Treasury futures markets very closely and see where we observe pockets of stress or even concentration from players, between the principal trading firms and the buy-side firms. But this really was to send a signal about that correlation, which ultimately leads us to a conclusion at this point that there's always more work to be done, and we have to be thoughtful about a growing market because size does matter. But when we see these correlations, I think it relieves a little bit of pressure around that systemic risk and stability issue that naturally comes when you have a market that this size. The slide that I think Scott Mixon, and credit to Scott, our chief economist, I heard from multiple people who did a great job this morning. But seeing that divide between the buy-side firms wanting exposure to treasuries, but using futures markets sort of as a balance sheet savings, and then obviously the principal trading firms probably on the other side going short, and the obvious interconnections with the repo market and the basis trade itself. So a few charts, as you said, and as you remember, we have great data and we work closely with our sister agencies, but in the context of the conversation today, what we heard on the previous panel about cash clearing, trying to sort of lend our expertise and our experience and our data to make sure that this transition goes as smoothly as possible.
That's great to hear. I think I want to transition into clearing because, as you said, futures trading has been cleared for over a century. Swaps market, largely under the CFTC's oversight, been clearing the last 15 years. Just going to that experience, and although we heard a little bit that swaps clearing isn't exactly like Treasury clearing, we know that, but there are some lessons learned, I think, and I just want to turn to that. I also want to talk about your role, if any, in the Treasury clearing mandate. And I do want to end on a note. There is another competitor in the Treasury futures market, and there's been some press in the last week about that competitor and where it might clear. I want to end there and get your views. So we'll try to make our way through all of those and leave time for questions. But post-crisis, the swaps market was mandated to clear. The interest rate market moved from 24% cleared in 2009. Just think of these dates, by the way, and what's happening in the Treasury cash. 62% cleared in 2017, and it's now hovering about 80%. And it's been that way for quite some time. So 20% uncleared, 80% cleared. What can we learn on that swaps transition to clearing that might be relevant for the transition to the Treasury cash market?
Yeah, I mean, those dates are interesting because the law went into place in 2010. The mandate at the agency level was 2012.
Right.
I think an exercise in practice and lessons is a slew of no action letters, I think, over a number of years. So as we all hope that Chair Gensler, having experienced the swaps reform and clearing mandate, will lead that charge as well as anyone. But understanding there's always going to be bumps in the road. You can't predict it. It's the nature of these things. And I think we heard that a little bit from the panel before. There's what feels to be an organic migration to clearing when the mandate is set. We heard that earlier as well. Despite the rule not being in place quite yet, the market has organically shifted to clearing at an incremental pace, and we'll probably continue to see that. And I think, and I don't know, you asked what role we've played or you suggested, and I think it's worth talking about. I probably mentioned this last year or the year before. This is now year 4 here, but we've consulted, in some respects with the SEC. We've had a lot of market participants come to us and say, what do you think is going to happen? What role are you going to play? And in many respects, we don't have a direct role.
Right.
But it is exactly what we're talking about right now is we have this firsthand, very timely experience from just 10 to 15 years ago, which hopefully will serve as a model for the transition going on now. And I think we also heard from the previous panel the multiple types of structures. And if I think about clearing and what we've learned, and one of the more important elements of that transition on the swap side was with the clearinghouse, you're eliminating counterparty credit risk. You're novating the trade to the clearinghouse. And in theory, that should itself help support a migration to all trading and equal access, which was and continues to be a very important component of, at least as I'm chair, and I know some of my predecessors, a very key component to healthy, transparent, and vibrant markets. Ensuring all players have that access and ensuring that sort of all-to-all, to the extent it can exist, model work. So as I think the competitors take cue and take place and the rule gets, closer to implementation, I think that's something that's been important to observe in the swap space. And I think it also demonstrates why you've seen such healthy adoption in the marketplace up to 80+% over the course of really about 10 years.
10 years.
And I think the net of it all is a very positive, healthy swaps market where you have strong price transparency and ultimately a desire by market participants to clear swaps where you have standardized products.
I think it's really interesting that we've now confirmed 3 times, and I think Michelle did it again, saying, we all agree with clearing, right? I think so. You got that single confirmation again on the panel, but when swaps clearing was happening, the manner it was happening, there was still this feeling that you were just shifting risk. Yeah. You were taking credit risk and putting it into this beast of an infrastructure that all major banks and others were connected to. So if something were to happen to that, we're all in trouble. And I just wonder what you say to that. I don't really hear that tone today. I wonder if everybody's whispering it outside. I don't know. But what do you say to that?
Well, I hear it a lot.
Okay.
I mean, I think I hear it a lot in the context of, we have an FSOC committee thinking about non-bank institutions. CCPs are one. A huge registrant of the CFTC are the clearing member banks, and there's that natural, and I say this in a positive way, a natural friction between the clearing member banks and the CCPs. And yes, you're concentrating risk in a single location, but you're making it more transparent, right? And I think as a regulator, having a single source to look to in terms of data, risk, and risk management becomes very healthy, and allows us to be better regulators, quite frankly. But ultimately, it does go back to that earlier question, or my earlier point, because I do think, there's merit to that argument, but I would much rather have that risk in a single location as opposed to literally hundreds of locations in a bilateral way. And I sort of joke, but it's really a very serious issue and one I take very seriously. I've had many conversations with many of you in this audience about that relationship between the CCP and the clearing member, ensuring it's transparent, making sure that there is coordination and strong governance. And as we think about margin calculations and the default fund and contributions and the whole operational risk, but also the credit risk that's evaluated and analyzed by the CCP has to be thorough. It has to comply with the CFTC rules, but there's naturally a commercial element to it which I cannot intervene on very clearly. And that's where I think it becomes very important for the CFTC to be a convener, to have these conversations, to analyze the risks, to use the data we have, and ultimately, hopefully, push the market in a position where everyone gets more comfortable. And, for me to think back on the previous 4 years, coming off of 2008, obviously, and the crisis there, but since 2008 up until COVID was fairly flat markets. You had the sovereign debt crisis in 2013 and some bumps with Treasury markets, but 2020 was massive in terms of market shocks. That goes without saying. And then even from a commodity perspective, the events that followed the invasion of Ukraine by Russia and how that had an impact on all financial asset classes, but specifically commodities. So what does that lead to? That leads to margin spikes. That leads to issues around margin methodology and how are we thinking about anti-procyclicality. So this all kind of falls into line of your question is, would I much rather have it in a single location? I think, if I had to think about all of those factors, the answer to that question is probably yes, but it still doesn't make me necessarily comfortable that we're doing things as well as we should. And that is absolutely not a criticism of the CCPs. I think they do a great job, but it is incumbent as a community of market participants and regulators and academics and everyone who's engaged in the space to constantly be, pushing the line and having that healthy friction of ideas so the market can become more healthy, more transparent, and ultimately reduce the risk of financial stability issues and crises.
Well, and I know the CFTC has done so much even in the last year regarding margins and stress testing of CCPs and Now I kind of see the insight there. You know, your work is never done, and I appreciate that.
But I heard multiple times at lunch, still more work to be done, right? And that's fair, and I get it, and that's the job.
Okay, always.
Yeah.
Well, I'm going to ask you another tough question.
Yeah.
And by the way, I love clearing. Let me just get it. My boss is here. We love clearing. We're FI, we represent the clearing members. But let me just give another tough one.
Jackie, one point too.
Yes.
I've said this a lot too in the context of Treasury clearing. You think about the crisis and moving OTC derivatives to clearing. We built that off the shoulders of futures, right?
Correct.
Which you alluded to, and then now
Correct.
in many respects we're building Treasury clearing off the shoulders of swaps clearing and of course futures. So it was a market that functioned largely well during 2008, largely, not perfectly, but it certainly served as a model for why clearing is good and why it's healthy and why in the end it's a net benefit for markets.
Right, and I think people largely now accept that. These are little nitpicks about what's happening now, and I'm going to do it again. But another concern out there, and it came up on one of the panels, is the concentration of clearing members in the swaps market, particularly according to your own data. Currently, there are 12 firms willing to clear swaps for clients. Let's just compare that. 49 firms willing to clear in futures. Just a huge difference. Do you think there's capacity for Treasury clearing, for agency?
Yeah, that's a tough question, and one that I think is more quantitative. I would even hesitate to see something off the cuff without really having the data both on the capacity side in terms of the balance sheet for the large dealers, but also the actual size of the market and how those two are going to connect. But I think it is worth noting, and I've said this a lot in the past year in the context of Basel and the GSIB surcharge, which might be a sensitive topic, but there were ideas about how that initial proposal was going to impact derivatives clearing, and I had testimony at the House Agriculture Committee, which should have focused on the CFTC, and I think 30% of the questions were about Basel, and I think the idea was, how is this going to potentially negatively impact clearing if there is a surcharge on the balance sheet for derivatives products, right? And I think the Fed, I know it's still early days now, but at least from some of what I've read in the press, there was an observation that, perhaps we move in a different direction, more to be seen there. But I do think it's important, both from a regulatory perspective and a market perspective, that we recognize the size of the market and the capacity of the dealer community to absorb that market, because without a match, if there is a mismatch, you're going to have that concentration. And you and I have talked about this, but the numbers and the data it's quite staggering in the derivative space, what we've observed over the past 25 years. Yeah. Or so, and a lot to do with the macro interest rate environment and that trend lower and making the business itself a little bit more challenging. But ultimately, we've gone from 150 to maybe 160 CFTC registered FCMs at the turn of the century to just about 55 or 60 now. And then even within that group of 55 or 60, you're talking about half dozen that are really clearing 60 to 80% of the market, depending on the product. So in the context of FSOC and in the context of financial stability and the interconnectedness of markets, within obviously the multi-agency, groups that are here, I think it's really important we think about how regulation impacts balance sheet capacity and ensuring that we're doing the right thing and thinking about the broad picture before we go down any one road, because as we've learned, it's all interconnected and we need a healthy dealer community and participant community and able to handle that capacity. So more to come. That was maybe a little bit of a work around your question, yeah. But I think, again, an area where we've had experience, and that's tough, right? Because in an environment where you're seeing consolidation, organic consolidation, you can imagine Credit Suisse and UBS. We lost Credit Suisse, obviously, in the past year or two. It's a large dealer that's gone. We have, I say this often, and it's maybe overlooked, but I love my job because of the constituency and how broad it is, right? From large financial institutions to small commercial end users. And I have to focus on everyone, but especially those small commercials who need to use our markets to manage anything across the ag energy or metals complex or financials as well, if you start to have costs increase because of less competition, or if you just don't have access to markets because these few large dealers are like, look, there really isn't a viable reason why I need to offer these services to you, that becomes very challenging. The depth of the FCM community 20 years ago was massive, and it really tilted towards smaller, more bespoke FCMs that were clearing almost at the local level, but for smaller commercials, and you don't see that as much now, and I think that becomes a very challenging issue I think that we should all care about, but certainly for those in Washington, this becomes a challenge because we want to make sure everyone has access to our markets.
100%. And so I just want to move really quickly to your direct role, which was raised earlier in the day, but cross-margining, you also have to approve this, of course. Where are we with client cross-margining? Is it in front of you? Where are we?
It's not in front of me yet, but I've spoken with my head of clearing about it, and we are anticipating it. One of our advisory committees did some work product on it, which is good. This, as many of you know in the audience, and I think it was suggested in the earlier panel, is not new to us at the CFTC and to the SEC, but within the context of a cross-margining between FIC and CME. This has been done before. I am personally open to this for sure. I think obviously there are efficiencies to be gained. There's balance sheet savings to be had in the context of cross-margining. This is, I think, in by proxy and naturally the benefit, one of the benefits of clearing. I think specifically, and have gotten a little bit smarter on this, more to do, but this distinction between house accounts and customer has to be addressed. I know that's been an issue that's raised in wanting to extend the cross-margining access to customers as well as house accounts. But that does raise issues around customer protections, which I think they said in my bio, that's my number one priority. So we got to make sure we take care of that. And we have the 4D customer seg model within the CFTC, different within the SEC. So I think whether, Chair Gensler and I probably at some point have to get together, obviously talk with the stakeholders and see what would work. And if he and the SEC is obviously willing to do that, it's going to take two to tango here. But I think from my perspective, I'd be willing to have that conversation, work through these issues, focus on customer protections, see what the market can absorb, and figure out if we can find a path forward.
Call Chair Gensler back, and you all can go have a meeting right outside. Get this done. Okay, so I want to get on to the competitor and Treasury futures products because it was in the press last week in Bloomberg and FT. Right now, Treasury futures is really done at one exchange, one clearinghouse. We have a new entrant, FMX. There have been many in the past that have tried and have failed. FMX launched SOFR futures earlier this week. Plans to add U.S. Treasury futures in the first quarter of next year. FMX does not have its own clearinghouse. It plans to use LCH, which is in London, to clear trades. So does that raise concerns for you?
Well, some more context, and I think this was reported in that article you're referencing. I received a letter from Senator Durbin a few weeks ago. He raised some very important questions and issues about that relationship between FMX and LCH, which is fully registered with the CFTC, but a non-U.S. clearinghouse, DCO. And as with any oversight from Congress, regardless of the member, regardless of the body on either side of the Capitol, I take this very seriously. We want to be responsive. We want to, make recommendations possibly. So given the letter, given the inquiry, and given the depth of, I think, of his questions around this specific issue, around market resilience and financial stability and that relationship with Treasury cash markets, I've reached out to Treasury. We're working on the set of questions he asked, thinking through the issues that Senator Durbin raised, and making sure that we're going to have a thorough analysis between both us and the Treasury Department, given obviously the connection with Treasury cash, and come up with conclusions and possibly recommendations. So I think, the market can observe whatever it wants, but we have a job to do. This is an important issue to discuss. And given the oversight, which as I do, in ordinary course, we're going to be responsive, look through it and take it very seriously, and dig through the issues and do the thorough analysis.
Okay. I have one last real quick question, and then I'm going to turn it over to the audience. 98% of the dollar swap market is cleared at LCH.
Yeah.
Is this different Treasury futures?
Well, as I mentioned, LCH is registered with us. We
Yeah.
have a very close relationship with the Bank of England. We have an MOU that really reflects and oversees the supervisory relationships we have between each supervisor and the registrants. I would say on the Treasury side and the issues that have been raised within the context of that congressional oversight, this is a physically delivered product, and the physical delivered commodity is a Treasury.
Yeah.
And I think that's different from, interest rates. That's different from SOFR, which you mentioned was listed this week. So you have convergence issues, you have physical delivery issues, obviously the basis trade, which, is reflected right behind us. So I think there are, at a minimum, several distinctions that one can make about the Treasury futures contract as it relates to SOFR or other rates products that make this particular product, Treasury, I think one worth looking at as opposed to the other. So for those several reasons, I think it probably separates itself or distinguishes itself from the other rates products.
Okay. More to see here. All right, questions? None.
No one ever won.
No. Oh, interesting. Okay. Well, I've got some more.
We got one back there.
Okay, right here.
Hey Russ, it's Bernard Goyder from Risk. What are your big priorities right now? I mean, we haven't talked much about carbon, but what are your key focuses for the rest of the year in your role as chairman?
Yeah. So thanks for the question. And Jackie alluded, I've been up here since Monday. We finalized some guidance on voluntary carbon markets, which really pleased to get that done. But we do have a slew of proposed rules that we're hoping to finalize in the next month or so, including operational resilience, which we proposed, recovery and wind down for clearinghouses over the next month or so, and then we proposed a rule on separate accounts, which has been an issue. We've been very engaged with stakeholders to get that right. Another proposal on eligible collateral we're hoping to finalize. And then I have mentioned over the past probably year and a half, in addition to those few things, which should wrap up the agenda that I outlined, I think, 3 years ago, which is nice. A lot of interesting new entrants into our space, many coming out of the crypto space and introducing new market structures and new models. And I think it's pushing us to really think hard about what the law permits, what's right on the policy side, and how much risk it introduces into the market. So I've talked publicly about conflicts of interest rule and examining the issues that arise when you have an integrated sort of vertically stacked entity that has, the broker, the exchange, and the clearinghouse in one. And I think we have a very engaged commission on that issue, and I want to make sure that as the agency moves forward, and I have no doubt we're going to have to continue to deal with these more new and innovative market structure models, that we should try to get ahead of this before it gets too far ahead of us. So something looking forward to towards maybe the end of the year.
Just a few things. Well, please join me in thanking Chair Benham.
Thank you very much, Chair Benham and Ms. Mesa, for that great discussion, which brings us to our second coffee break right outside here. And we will get started back up at 3:25, so a little bit over 15 minutes from now. Thank you.
Welcome back from the coffee break. If everybody could take their seats, we're going to move right into the third panel here. I'll give everybody a minute to sit down. This panel is going to discuss Treasury market structure, past, present, and future. I'm going to hand it over to Josh Frost, who will be moderating the panel. Josh is the Assistant Secretary for Financial Markets at Treasury. Before that, he worked at the New York Fed for an extremely long time, He was most recently the co-chair of the liquidity program for systemically important financial institution supervision. And then before that, he spent almost 2 decades in the markets group, overseeing the corporate credit facilities launched in response to the pandemic, serving as director of money markets, treasury markets, creating SOFR. And if I kept going on all the things he did, I would be up here all day. So please join me in welcoming Josh and our panelists.
Thanks. I'd love to know what the definition of extremely is, but maybe we'll leave that for another day. So given that we're here for the 10th Annual Treasury Market Conference, I thought it first makes some sense to reflect on some of the many changes that we've seen to the Treasury market structure over the past decade and talk a little bit about where we might be heading. So to that end, I just wanted to first provide a quick roadmap for today's panel discussion. We're going to start with a brief retrospective, starting with a discussion of the October 2014 flash rally, an event that signaled to many that the Treasury market structure had changed in ways we didn't fully understand, and which led to a series of work streams from the interagency working group that we've heard a bit about already today. Then chat a bit about how and why the Treasury market has changed over the past decade, including the various initiatives that the IWG has undertaken to improve the market's functioning and its resilience. Finally, looking to wrap things up with a bit of a discussion of the important work that remains and how we should think about prioritizing some of that work, and hope to be able to save a little bit of time for Q&A as well. So very fortunate to have a distinguished group of experts with us here today to help provide a range of perspectives on the discussion topics this afternoon. Thank you all for taking the time. Looking forward to an interesting and informative conversation. So with us today, first, Professor Darrell Duffy from Stanford University. Darrell is the Adams Distinguished Professor of Management and Professor of Finance at Stanford University's Graduate School of Business and a professor in the Stanford Economics Department. Darrell's a member of the leadership teams of various G30 working groups and has written and commented extensively on many of the ideas related to Treasury market structure and resilience. And today he's making his third appearance as a panelist at this conference. I will just note before we move further, earlier today I asked a popular generative AI algorithm, I'm hosting a panel on Treasury market structure, past, present, and future. Who would be good panelists? And I kid you not, your name was one of the 5 names spat out, so we have one of the right people on it. Second, we've got Matt Berger from Jane Street Capital. Matt is Jane Street's global head of fixed income, and he's been involved in ETF trading since 2001. Matt started his career trading for Jane Street on the floor of the American Stock Exchange and led the effort to build out Jane Street's ETF automated marketing capabilities in 2004. Third, we have Casey Sposano from NatWest. Casey heads up U.S. customer sales and trading for NatWest Group, where she supervises the bank's currencies, rates, and credit trading and sales businesses across the U.S., as well as the global U.S. dollar rates trading business and the U.S. markets strategy team. Casey is the chair of the Treasury Market Practices Group and is a member of the SIFMA Rates and Funding Committee. Fourth, we've got Sarah Devereaux from Vanguard. Sarah is a principal at Vanguard and global head of its fixed income group, which manages over $2 trillion in assets. Sarah chairs the senior investment committee team responsible for Vanguard's actively managed fixed income portfolios. Before joining Vanguard, Sarah was a partner at Goldman Sachs and focused on mortgage-backed securities and structured products trading and sales. Finally, we have Nate Werfel from the Bank of New York. Nate is the head of market structure at Boney Mellon. Previously, Nate was the head of domestic markets at the New York Fed, and in that role, he oversaw the TMBG and was instrumental in developing early iterations of this conference. So with that out of the way, let's jump in. So nearly 10 years have passed since the October 15th, 2014 flash rally that caught the attention of both market participants and regulators and ultimately sparked a lot of the IWG work streams that we've been talking about. Since that event, a lot of smart people across the private sector, the official sector, spent a lot of time thinking about the evolution of the market and the changing set of risks that this evolution has posed, and thinking about ways to mitigate those risks and improve the resiliency of the market, particularly in times of stress. So I thought it'd be worth looking back briefly at the events of that day, first to gain some perspective on the Treasury market structure and how our understanding of that has evolved over the past 10 years. But before we dive in, I wanted to just maybe first go back to that morning of that flash rally about a decade ago. I'll just share, I was, at that time, I was overseeing the Fed's mortgage-backed security purchase operation that morning. We were supposed to end the operation at 9:45, and as folks who were involved in the market that day know that about 9:37, the market did something unexpected. And so I recall at that time saying, what just happened? Every single inbound phone line lit up, people asking us what happened, a lot of head scratching. We extended the operation 5 minutes. The market was still unsettled. We extended another 5 minutes and said, let's get out of the market right now. And so we closed that and spent what we thought would be the rest of the day trying to figure out what happened. It turns out we spent a decade trying to figure out what happened. Does anybody else on this panel want to talk about what you were doing that morning and any specific recollections on markets that day? Maybe Casey, given where you were, I'll start with you.
Yeah, I was trading or market making treasuries, short treasuries at the time. I was 9 months pregnant and overdue. And the markets went nuts and the entire floor erupted. There was no market release. Everyone was looking for a headline. No one knew what was happening. So it was very unsettling. Unfortunately, not enough for me to go into labor because I was still pregnant another week, but we managed through.
Thanks. So, So, Nate, you were at the New York Fed at the time, and you and your team were instrumental in leading some of the official sector response and analysis of that event. So can you take us back a decade? What happened? What did you know? What did you not know? When did you know it? And that first report that got produced trying to do the postmortem, what was easy but probably more relevant? What was hard about putting that first report together? And can you give us just a brief summary of what was in that first report?
Sure. Yeah. I mean, I think anytime you have a crisis, it sort of gets subsumed by the next crisis that happens or the next event that happens. So in some ways, when you look back at the events of October of 2014, they might seem relatively small today. You know, you had this event in the morning. I think it was 9:33 a.m., but close. But you know, you had this event at 9:33. You have a flash rally that's, the market moves 16 basis points round trip in 12 minutes, and then there's a 37 basis point trading range during the day, which is one of the largest in the last 15 years at the time. Today, that when I say those things, they don't sound super significant in light of things like the pandemic and how the Treasury market functioned at the time. But when you put it in the context of what the public sector and the private sector relies on the Treasury market for liquidity, it was very significant at the time. And just to put this into context, I mean, Chair Gensler brought up Alexander Hamilton earlier, and I like to bring him up too, in part because he founded the Bank of New York. But Alexander Hamilton, when he basically puts the U.S. government's finances on firm footing, he does it on two characteristics that are very fundamental to the Treasury market today. He puts it on the characteristics of safety and liquidity. And those two characteristics have been the defining characteristics of the Treasury market since its inception. And so for now over 200 years, you have this market for national debt that is founded on safety and liquidity. And so when you put it in that context, when you have this event that turns out to be quite inexplicable, like what is special about 9:33 in the morning? Not much, it turns out. That morning there was a retail sales data print at 8:30 that was somewhat weaker than expected. There were some worries about deflation in Europe, but by and large it was an inexplicable move. And so that prompted both the private sector and the public sector to ask the question, how can we make this market more resilient? And what do we need to do to understand this event? So I was asked to lead a team, an interagency team that investigated it. It took us 9 months to produce a report on the flash rally. And one of the reasons for that is, in the first instance, your job is to go out and talk to the market and understand what happened. And we know how to do that, and I met many of you in that process. But the second thing you really need is data. And on the data front, it was incredibly challenging, actually. We had some data that was given to us voluntarily by trading venues, but a lot of the data didn't exist at all in a centralized format. And even when it was provided to us, there wasn't an easy way to share it among the agencies. So we had teams of people who were in, 10 by 10 rooms down in DC, going into locked rooms to access a single computer that had data. We now have there are interagency data sharing agreements that make that a lot easier. So it took us a while for those reasons. But there were a number of findings that came out of the report. I think in the first instance, as was mentioned earlier, electronification had arrived in the Treasury market, and that wasn't so apparent until the flash rally had occurred. Intermediation had changed in the Treasury market. In the interdealer markets, it was principal trading firms that were now the dominant players the largest share of activity in those markets. And we also could see that the Treasury market was becoming even more interconnected globally to other liquid markets around the world. So those realizations, I think, then resulted in a set of recommendations. First, around risk management practices. There's continued developments in the regulatory space, but also on the private sector side, the Treasury Market Practices Group had a whole bunch of work that came out of there. It also resulted in data collection through TRACE, which has now reached to the point where we have daily reporting on TRACE data. And I think it sort of galvanized the public and private sector efforts to make the Treasury market more resilient, including the development of this conference.
Yeah, I'd like to generally reflect on the fact that this Interagency Working Group on Treasury Market Surveillance, or IWG, right, people have heard about it a lot over the last decade, especially the people who've been in this room at this conference over the past decade. But it goes back to '92. Yep. And there's generally not a lot of public awareness of it prior to that date. So it definitely seems like a bit of a watershed event. Maybe we'll pivot now a bit to some of the drivers of the change in market structure. I'd like to ask a few of you all, what do you believe have been some of the biggest drivers behind the continuing changes to Treasury market structure over the past decade? Are they regulatory, technology, market conditions, the economics of intermediation? How would you weight these and other factors? And maybe, Darryl, I'll start with you.
Happy to. Thanks, Josh. We've been hearing all day about the size of the Treasury market, and I think that's by far the most important factor that everyone's dealing with. On the eve of the financial crisis, there were $7 trillion of Treasuries outstanding. Now, we saw in Ross Benham's chart, there's in excess of $27 trillion, and that's projected to go to $50-ish trillion in a decade. So I think the Interagency Working Group, and more generally, everyone, market participants and official sector alike, can see the writing on the wall. That market is growing very fast, while at the same time, regulation, most of it appropriate regulation, has tamped down the appetite of the largest intermediaries in the market to provide liquid markets when their balance sheets are reaching capacity. And, since the financial crisis, the largest financial institutions are now regulated for capital and liquidity in a way that discourages them from instantly expanding their balance sheet for a few basis points of arbitrage profit. And in the course of that, it's made their balance sheets less flexible and less able to expand in an event like March of 2020 or the global financial crisis. Some of those, in general, those capital regulations were necessary for financial stability. There's one in particular that came up this morning, the supplementary leverage ratio, that's probably not helping in the following sense. First, these capital regulations are meant to cover the risk of changes in the value of assets, but Federal Reserve deposits don't have any risk of change in their value. They don't need a capital regulation. But on the other hand, when the Fed jumps in and provides liquidity to the primary dealers in an event like March 2020, they pay for that with Federal Reserve deposits, which attract a big capital charge under the SLR. Some recent research at the Boston Fed this summer came out, a paper by Falk Breining and Hilary Stein, that showed that when the Fed on April 1 of that year exempted treasuries and reserves from the SLR, suddenly the banks that had the least headroom under that capital regulation expanded their balance sheets to provide significantly more liquidity to the market. So, regulation has been largely an adverse factor to liquidity. With the huge growth in the Treasury markets, regulation has held back liquidity. But you'd want that financial stability from regulation. The SLRs, however, is not helping.
Got it. Okay. Thanks. Maybe Casey, pivot to you.
Yeah, I agree with everything that Darryl said. I think the increase in issuance 3 times with balance sheets really not changing, if anything, more constrained by regulatory changes. That relief in SLR during COVID was huge. I remember everyone waiting to see what the outcome was going to be, if it was going to remain permanent, if it was actually going to be going away. That was a big market moment. I do think also, in addition to those two, technology and the electronification of the market. So from a technology perspective, we had an increase in trading platforms. All the improvements in tech has allowed more ease of trading and new participants into that space. On the electronic side, the market continues to move towards E, and it will only continue to go that way. We saw it in equities first, then the FX market, and now we're seeing it in the Treasury market. 60 to 70% of U.S. Treasuries are trading on the electronic platforms. And if you just focus on the runs, that number is closer to 90% when you factor in the algos and the aggregators. So as the market continues to move to E, we're going to see markets move quicker. We're going to see markets move faster to market events. So it's something that we all need to continue to monitor.
Thanks. Matt.
Yeah, so we play a couple different roles in the market. One of them is as a client of the primary dealers and risk taker. And I just want to kind of highlight the points that both Daryl and Casey made, that to the extent that banks are constrained, that's going to flow through to investors throughout the market. And it's not like if they step back, we're going to then step up or something like that. It doesn't really work that way. We're reliant on those primary dealers in that way. Other major way that we interact with the market is as an ETF market maker. So we're market makers in, hundreds or thousands of fixed income products. And it's worth noting the assets under management holding U.S. Treasuries in fixed income are up about 8 times since 2015. The diversity of players is much larger. The interest internationally is much larger than it used to be. So it's just become a much larger portion of the holdings. It's still a pretty small portion of the overall U.S. Treasury holdings, but I think it's worth noting that the ETF market is largely holding off the runs, and it's become, had an outsized impact in off the run as compared to on the run trading. So then moving on to trading, volumes are also up about 5 times, and trade sizes have become much larger. If somebody wants to move a large block of off-the-run securities as a single treasury, that's very challenging. But if they're moving it as a basket of securities in an ETF or similar product, that's a lot easier. And I guess I also wanted to echo the point about electronification. Now, almost no matter how somebody's trading, whether it's RFQ, whether it's streaming, whether it's in the inter-dealer market, those trades are happening electronically, and they're happening faster than ever. I think, speed and transparency are 2 things that can go together. And we think of them as good things. Generally price discovery happening quickly and transparently we see as a positive. But there is also still the risk that those things happen almost too quickly for humans to interact. We hire a lot of humans. People sometimes wonder why we have so many humans. And a big part of it is because your algorithm can't be trained for the flash rally and for some of these really unusual situations. So it is kind of interesting. We're very much on the side of allowing price discovery to happen as quickly and transparently as possible, but at the same time it can lead to things moving more quickly than others. And then I guess just getting back to the off the runs, I wanted to mention the interagency working group priority, which is the buybacks. I think this is something that could have a significant impact on liquidity. Right now there's not a whole lot of incentive for a research analyst to do research on an off the run treasury. There's not going to be an event, there's not going to be an upgrade, there's not necessarily going to be a catalyst to drive that price higher, and I think that if Treasury increases the buybacks, that could bring more liquidity.
Great. Thanks, Matt. So we'll get to the future of the Treasury market later. I'd like to ask about doing away with humans in the Treasury market when we get to that portion. Maybe take a few minutes now, talk a little bit about the changes in market structure that have impacted behavior and risk-taking in the market, as well as the impact that some of the IWG efforts to foster liquidity have had. So, Casey, I'll start with you. A few questions, and feel free to take these in any order you'd like. First, from where you sit as a dealer and as a market maker, over the past 10 years, has it become easier or more difficult to make markets in treasuries in good times and stress times? And how has that altered how you as a dealer approach risk management? Second, how has the rise of principal trading firms impacted the customer flows that you see versus the past? And how has the concept of a customer franchise been impacted at all by the advent of new types of liquidity provision? And then finally on repo. Repo is pretty clearly the lifeblood of the Treasury market. What, if anything, has been the impact of all these market structure changes on your ability to finance positions in repo? So a lot there. Take it wherever you'd like. Yeah, exactly.
So, I'll start with the beginning. So a market maker, normal markets right now, pretty easy. We're challenged in off-the-run sector. The on-the-runs, we have, high frequency firms that are helping out. The ease of electronification of the market definitely helps. Dealers are there to intermediate risk in the longer end of the curve, which is harder in the off-the-runs. Takes a little bit longer to move that off balance sheet, so that needs to be monitored. The buybacks, small in size, but are helping the market and helping to have that natural buyer in that space. If you look at the holdings by primary dealers over the last decade, you see a big increase as issuance has gone up as expected. And since COVID, that's been an even sharper increase. So it's definitely something as a primary dealer where your balance sheet is constrained, you need to continue to watch. In stressed markets, it's different. You see a lot of those non-traditional players pull back. And, dealers have to lean in. And we've seen those sharp decreases in liquidity around big stress events, COVID, the ICBC, cyber event, SVB. When you look at the top of book, market depth, which is a big sign of liquidity in the market, you graph that against volatility, you see a big inverse correlation. So it is something that, the market continues to watch. As far as risk management, markets are moving quick. You need to know exactly what is in your book and trading books at all times. And you also now have to measure what you're holding from on the runs versus off the runs, especially around, reporting dates, stress events, because you're not going to be able to move that off the run paper very quickly. Thinking about second question now, and hear me if I'm going in the wrong direction. So non-traditional players impacting customer flows and the thought of a customer franchise. So electronification, obviously there's a food fight for market share, tighter bid offers. There's a big focus on price over relationships during normal market conditions. There's a lot of improvements on how the customer base can come into dealers, changing some of the dealer selection capabilities within the platforms, and that allows customers to really fine-tune what part of the curve they're going to the dealers that they find to be best in that space. So that's definitely helpful for liquidity. Stress events, I think that highlights more than ever that this is a relationship business. If you have to move large blocks of paper in a stress event, you need to lean on the relationships you have, your strongest relationships. And those are not built up in those market environments. Those are built up in those normal times. So for the off the runs, for longer dated securities, in order to move them, it goes back to relationships. So it's still very much a relationship business. So that's where that customer franchise really kicks in. Now, repo, lifeblood, oil in the engine, we've had a lot of different terminology for it. Repo keeps the market going. And when there's cracks in the repo market, we feel it widespread in various different product sectors. Over the last 10 years, it's been super imperative to be able to optimize your balance sheet. That is the number one skill right now on any single repo desk. You have to be able to optimize your balance sheet, optimize the capital that you have to ensure you're using those resources and putting those to the best opportunities and to the best relationships where you have a well-rounded, multi-point access point into a customer. You want to use your resources there to get the most bang for your buck.
That's great. Sarah, I've got a similar set of questions for you, slightly different perspective. From where you sit as a large end user of treasuries, is it easier or more difficult to trade in and out of your portfolio positions in good times and in stress? How do you think about the intermediation needs that your firm has and the liquidity that you see versus where we were, say, a decade ago? And how's that changed? Is it better, worse, different in some way? And have these changes in market structure altered the way you think about managing risk?
Well, I'll say it's really great to be here again to bookend the conversations we were having at the 2020 conference. I was on this same panel, the market structure panel. It was virtual. We were talking heads on, I don't know, was it Zoom or WebEx? I think you guys are WebEx. And we were really talking about the challenges in the market and trying to sort out what had happened and why. So I would just say, we've come a long way in 4 years, thanks to a lot of the work of the interagency working group and many of the people in this room. A couple quick points on market structure and how it's evolved. I would just double down on two primary drivers that most of the panelists mentioned. But first, the growth of the market. Treasury market's more than 2 times the size it was a decade ago. And the second is really as you were describing it, that inflexibility of the dealer's balance sheet because of bank regulations, right? So effectively, more bonds, less balance sheet for intermediation creates this bottleneck. That bottleneck is exacerbated in times of stress. So I'll highlight a couple periods that were challenging. September 2019, you'll probably all remember, repo rates spiked. At that time, there was a confluence of events. Many things were going on. There was Treasury issuance, there was taxes, but one big thing that was happening was balance sheet runoff. The reserves were decreasing in the system. They got down to $1.5 trillion, and it wasn't really clear where the toggle point was between ample and scarce, but I think we may have found it that day. The markets locked up, and dealers were not able to flex their balance sheet to lend in the repo market. So repo rates spiked. Now, I bring it up because I do think that may have been a bit of a canary in the coal mine before March of 2020, is a signal that in that market plumbing, that some of the pipes were rusty. Right? So fast forward 6 months, March of 2020, rusty pipes, you basically turned a fire hydrant on to go through those pipes. The dash for cash, classic intermediation channels were overwhelmed. Dealers were unwilling, unable to provide liquidity. I'm going to draw a contrast to 2008, which was what I would call more of a credit crisis than a liquidity crisis. In 2008, bonds were clearing, right? There was a bid. You might not like the bid, but there was a bid, and you could sell, right? In contrast, in 2020, many dealers just closed shop in some sectors. Off-the-run treasuries, for example, wouldn't make markets. I think what's really interesting that I'll highlight during this time, and I mentioned this in 2020, was that at that time, Vanguard, we had cash. We were in the position to be a liquidity provider. We were looking to source off-the-run treasuries, and it was very, very difficult to buy bonds in that period. Most people talk about all the selling we were trying to buy in our active portfolios. So fast forward to today, conditions are much better on a day-to-day basis. We're not as good as they were pre-COVID, but they're better, much better on a day-to-day basis. We don't have liquidity concerns. There have been a couple periods where there was a bit of a bobble. I mean, I would call out February 2021. There was a 7-year auction that was a little bit tough. And then, of course, the bank stresses. Last year, there were some dislocations in the market, but nothing anywhere near what we saw in March of 2020. And currently, conditions are getting better. I mean, the buybacks are helping around the edges. QT is decreasing, and so generally things are better. I would highlight in August the yen carry trade unwind. That was a very volatile period. Very orderly price action in the Treasury market. Trades got done very cleanly. All that being said, things are better, but we are not out of the woods by any means. There's still a good deal of work to do, which I know we'll be talking about more today.
Super helpful. Matt, your firm's not a primary dealer, but firms such as yours in many ways function as liquidity providers, just by virtue of the sizable trading activity. I'd like to get your perspective on the evolution of the ability to trade in size, both on the runs and off the runs. What's changed over the past decade from your perspective?
Yeah, maybe I'll highlight a little bit more about what Sarah says. And we've talked about transparency, and particularly in off the runs. Maybe a story from COVID from 2020 was, I talked about our role as an ETF market maker. ETFs were trading at a big discount, and we were providing liquidity to those flows, and we were interacting with dealers. But I do think it's an interesting contrast to the corporate market. The corporate market had a very similar price action, but with Trace, the whole world, the public knew where those bonds were actually clearing. Whereas with off the runs and with tips, I think it was pretty blind, and that might have been one of the things that made it more difficult. So we're starting to see more transparency. We now have daily reporting of on the runs on Trace. That's going to allow firms like us to be more active. And my expectation is that we're going to continue to see initiatives to have more and more transparency to allow more investors to access markets when those investors are most valuable.
That's great. I would just say, look, I'd be negligent if I didn't mention this, because Treasury said this at this conference the last 3 years. We're on a walk, don't run pace to increase transparency in the Treasury market, and that journey continues, even though we didn't give a speech on it this year. So, Daryl, Treasury debt's grown a lot over the past decade, as you've noted, faster than dealer balance sheets have been able to adapt to be able to intermediate these flows. How has that really impacted liquidity provision? What have you seen in terms of intermediaries responding to optimize their use of balance sheet?
Sure. Well, I'm going to end up amplifying on what Sarah and Matt just said on the basis of some research, actually, I did after COVID and that shock to the Treasury market. I came here to work with an expert team here at the New York Fed. I see Frank Keene is here among that team. And we dug into the data on, what actually does resilience mean quantitatively. And remarkably, Treasury market liquidity, no matter how you look at it, whether it's bid-offer spread, price impact, depth, on-the-run, off-the-run spread, many indicators. It does vary a lot, but most of the time it's just varying with volatility. The demand for immediacy and the provision of immediacy both shift with volatility. That explains about 80% of the variation in liquidity. And that's quite a wide spectrum. But something very unusual happened in March of 2020. That relationship totally broke down. And we were seeing illiquidity by whatever metric way off of that relationship, but in relationship to the extent to which dealer balance sheets were getting overloaded. So when dealer balance sheets are, let's say, whether it's in terms of gross positions, value at risk, flows onto their balance sheet, almost any of these metrics, when they're within a low level and up to 40% of the maximum they've done, that variation doesn't matter. It's just volatility. But when dealer balance sheet loading gets above 40%, then illiquidity becomes much, much worse, like 2 standard deviations worse. And so the idea that, yeah, it's true the Treasury market, even in stress events, is the deepest and most liquid market in the world. Let's not forget that. That depth and liquidity is not resilient to dealer balance sheet loading. That's the key bottleneck, and has been mentioned several times in the room.
Makes a lot of sense. So maybe just to follow on, if you look at all the official sector response over the past decade, all the work streams, responses from the IWG, which ones do you think we're going to have the most benefit to the Treasury market, which are going to have the least benefit over the medium to longer term? I'll start with you, maybe go to Nate as well.
Sure. Well, I mean, the respondents' poll this morning, I thought, was on the mark. I think central clearing is by far the most important. I would say, though, that there's no silver bullet. No single reform in progress or anticipated is going to cure this problem, but it's a question of doing everything possible and reducing the severity and frequency of these events. On top of central clearing, you might, and it's been mentioned before, I think Paul mentioned it, that might piggyback into all-to-all trade. Trace will also contribute to generating the fostering an environment in which all-to-all trade. And if that actually takes hold, the majority of trade will probably still be dealer intermediated, but you'll have these additional outlets for liquidity. So I think those would be the top 3. Buybacks is very important. Reforming the supplementary leverage ratio, those are all very important. But I think that IAWG deserves a real, high grade for what is put in motion already.
If you want to tell us how good looking we all are, we'd appreciate that too. Nate, over to you.
Yeah, I mean, I think that there's a lot that the IAWG as well as the private sector have sort of done together over the last 10 years. If you look at the slate of the 5 work streams that the IAWG laid out, I think there's been a tremendous amount of progress there. I tend to look at those things from those 2 characteristics I mentioned before, safety and liquidity. I would say, by and large, there's been probably an emphasis more on the safety side than on the liquidity side, though there's been improvements in both. And when you look at the different things that those changes have required, whether that's more transparency, sort of more consistent risk management practices through a series of proposals and changes that have come out of the official sector, sort of more capital in the system that is required by things like central clearing and other changes. I think the market is a safer market. And in some ways, it goes back all the way even to the global financial crisis. The thing that has been worked on through a series of reforms is to make the markets safer by putting more capital into the system. I think in a market that is $27 trillion today and going to $50 trillion in the future, it must be both safe and liquid. And on the liquidity front, I think that there's more work that will need to be done to make that happen. I think central clearing is a great example of this. Central clearing is the most significant change to the Treasury market in decades, period. So it is I think the sort of the biggest plank in the IAWG's plans. And what central clearing does is makes the market safer by reducing counterparty credit risk. And it does that because it forces trades into clearing. And once you're in clearing, you have margin, you have default management processes, you have contingent liquidity requirements, all of which central clearing require. So that will make the market safer. It will make it more resilient in times of stress because people won't back away from each other because of counterparty credit risk. But what it does is it transforms that counterparty credit risk into forms of liquidity risk or liquidity demand. So margin is on every single ticket that goes through, margin is paid. Along with that come these contingent liquidity requirements. So what it does is it creates a new source of liquidity demand, including in contingency scenarios. So when I think about this slate, I think, it really maybe leads into the next part of the conversation, but I do think it's very important that it be complemented, both the safety and the liquidity, by things like making central clearing margin efficient. I think done-away clearing, which we're working on at BNY, that can give people access to the market at lower cost. Lower cost means more liquidity. So I think that there's a series of things like that need to be complements to the work that's underway.
That's great. I've question on transparency. It's come up a lot in our discussion today. Maybe I'll start with Matt and go to Sarah as well. Your thoughts on transparency that we've seen to date on net. Has it been beneficial both to the market and to Treasury as issuer? And any thoughts you have on a go-forward basis there?
I think it has been beneficial. I think it allows a lot of more firms to participate, to provide liquidity, particularly in times of stress. And I think the biggest change is going to be real-time and more information on off-the-runs, where I think it's the most needed. Even if you did real-time trace and on-the-runs, it certainly would add, but I don't know that it's even necessary or all that important, whereas real-time information for off-the-runs I think could really make a big difference, particularly in times of stress.
I would say I think about the benefits of transparency in along two veins. One is that the day-to-day benefits that Matt's referencing. Flow begets flow. You see a trade spot, you like it, you're a buyer, you're a seller, more trades will happen. So it really greases the wheels of price action. I can't help but think if we had Trace in March of 2020 when we were trying to buy off-the-run treasuries, maybe we would have been able to source some. And the second angle, I think, is really for regulators in times of stress when you're trying to diagnose what is happening. Having that transparency, I think, is really helpful. For example, in March of 2020, many market participants thought that it was the open-end mutual funds that had outsized selling that was really driving the market action. And in fact, the selling that was happening was a fraction of what people thought it was. The ICI did some research. We collaborated with them. It took months and months to reassemble that data on a day-to-day basis, a fund basis, but we did put it back together, and it showed that the selling by the mutual funds was less than half of what people had speculated, and that foreign investors sold 3 to 4 times as much as the bond funds. And this is a couple years later that we figured this out, and it would have been really helpful for regulators to have that information in real time.
It's really helpful. It seems like it's a theme of having better data real time or closer to real time helps with the diagnosis of problems. I guess we're a little better. Instead of taking years, it takes months. So maybe we're going in the right direction. I've got like 40 more questions. We have about 5 more minutes, so maybe I will boil down my questions about the future into one question, and I'll just go down the line in the interest of time. So we've talked a lot about where we've been and where we are, maybe just a bit about where we're going. A lot of work going on in the IWG, a lot of trends in the market. High-level thoughts from each of you. What's the low-hanging fruit for the official sector to focus on? Are there things we should prioritize over others? Are there things the private sector should be doing that's not currently being done? Or the things the official sector should work on that are not currently being done? Just overall thoughts on the future. Maybe, Darryl, I'll start with you and we'll go down the line.
Sure. Well, most of them have come up in one way or another today, but done-away trading is not currently on the map, other than in conversation. I would mention, I already mentioned the supplementary leverage ratio. I'm going to mention something that hasn't come up yet today. In order to provide resilience to the market at the times of greatest stress, it would be very helpful if the Federal Reserve was actually a member, a non-loss-sharing member of the largest central counterparties. We have one today, but there may be more than one. But by being a member, that would put the Fed in a position of allowing primary dealers who are trading with the Fed to net their trades down against their customer positions at the CCP. And it would also, in principle, allow the Fed to provide liquidity against Treasury securities, which is what central banks are built to do, and also potentially, if they need to reach a wider set of counterparties, but not face them from a counterparty risk viewpoint, face rather the central counterparties. So that's something that I think down the road could be added to the agenda as for the official sector to investigate the efficacy of that.
Thanks. Matt?
Mine's more micro, but with the rise of indexing, the end-of-day pricing has become more important than ever. And I think especially with central clearing, it is going to have to be a market-based solution, but the idea that there's kind of tradable end-of-day closing price for treasuries, I think would have an impact on a very large amount of trading and, have an impact on getting good marks for all the funds that hold treasuries.
Thanks. Casey?
I'll add, obviously transparency comes, it's very beneficial, especially for the official sector. A lot of benefits there, but I do think we need to, as we move forward, think about how much additional transparency we want to bring into the market. You mentioned off the runs. For me, I'm a little scared about that. Off the runs being out there real time. That could potentially hurt, the end user and increase the cost of financing the debt if there's too much information out there. It takes longer to move off the runs in the market, and if everyone knows what position you're in and at what price, it can make it more difficult moving forward.
I think there were a few questions you asked, so I'll try and hit them quick. But in terms of trends, I would cite 3. More U.S. debt means more U.S. treasuries. That means we need more balance sheet dedicated to intermediation. Otherwise, that bottleneck will get worse. Secondly, in terms of the participants in the treasury space, they are more price sensitive than they were. This is a trend. That means not only are there more bonds, but there will likely be more flow and more volatility. Volatility can feed on itself. And the third is we've seen volatility in the term premium. You may remember about a year ago, 10 years backed up to 5%. Fortunately, buyers stepped in. But I will tell you, in almost every client meeting we have, they ask about fiscal sustainability. And so it is very topical. So market intermediation is critical. We talk about all-to-all. I think it will help on a day-to-day basis. But in times of stress, we will still need the bank balance sheet, the dealers to step in, and that's really, I think, where SLR comes in, as many people have mentioned today and Nellie mentioned in her remarks recently.
I think just to pick up on that theme I was talking about earlier about liquidity, and I think as you look ahead for the next decade, the need for public and private sector sources of liquidity is just going to become more important. And there's been a number of steps there that have, I think, been improvements, the standing repo facility, the buybacks. But when you think about some sources of contingent liquidity, the improvements that are needed around the discount window and the use of public sector sources of liquidity by critical elements of the financial market infrastructure, I think is really important. And it's also something that the private sector side can work on in terms of the mobility of collateral. The ability to turn collateral into cash is fundamentally what liquidity is about. And so being able to mobilize the collateral, creating markets for intraday repo. So we're doing that on the tri-party platform. We have intraday and early morning unwind tri-party repo today that people can transact in that can make liquidity more continuous. So those are all examples, I think, of ways that both the public and the private sector can make the market more liquid as it gets safer.
Can I quickly mention
Please,
one more?
yes.
Matt mentioned end of day, and I was thinking of the initiatives that are already taking place at FIC and BNMY and other market participants are looking into the idea of blockchain-based or tokenized, at least, claims on Treasury securities. That would potentially allow global market participation, collateral mobility, 24/7, 365. It's not happening in the next year or two, but I think it might be a good idea to put it on the agenda of things to foster or to at least investigate in the coming years.
So we'll have you back for the 2034 conference for the in-depth panel on tokenization, and we'll punch that ticket for what'll be your 14th panel by that point. I think we're probably at time. Please join me in thanking our panelists for today's discussion. Thanks, guys.
Thank you again for that discussion. We have another poll question, which I hope will appear here shortly. Just like last time, you can scan the QR code, go to the website, I'll let you do it. Maybe one slight difference on this one, you can select multiple choices. So if you think there have been several most important changes. And here I thought the standing repo facility was going to get more votes. All right. Increased size of the market seems to be a leader. All right, well, while the rest of those responses are coming in, I'm going to introduce our last and final speaker of the day. I'm very pleased to introduce Roberto Perli to provide some concluding remarks. He's the manager of the System Open Market Account, or what most people know as the SOMA. He's a senior leader in the New York Fed's Markets Group. In that role, he's responsible for implementing monetary policy at the direction of the FOMC. He has over 20 years of financial services experience related to both monetary policy and financial markets. Before joining the New York Fed, he was the head of global policy at Piper Sandler. He co-founded Cornerstone Macro, was a managing director at International Strategy and Investment Group, and served on the senior monetary policy staff at the board of the Fed. He started his career as an assistant professor of economics at UPenn. Please join me in welcoming Roberto.
Thank you, Brian, for that kind introduction. And well, thank you, everybody, for joining us, participating in what has been, I think, another truly exceptional conference, the Treasury Market Conference. So thank you to the participants and the audience for making it that way. And of course, a special thank you to the staff for the joint agencies for all the work that they put in organizing this conference. So sincere thank you for that. So this is the 10th time that we do this conference, and for the second year in a row, I'm the last thing standing between you and drinks, so I'll try to keep it manageable. I have a couple of things I want to say, so we'll try to keep it as short as possible. But anyway, today, a lot of people, a lot of participants have focused on many different aspects of the Treasury market. I would like to focus on one in particular, which is the short-term financing markets. So, of course, well-functioning financing markets are an integral part to meeting the objectives that the joint member agencies set for the Treasury markets, which are to minimize the cost of debt to the taxpayers, to support the broader financial system, and to support the implementation and transmission of monetary policy. So today, I'll start by providing an update on my assessment of current reserve conditions, and then I'll discuss the recent moderate pressure that we have seen in the repo market, and how those pressures have the potential for affecting reserve conditions. So before I do that, of course, I have to recite the usual disclaimer. The views I express here today are my own and not necessarily those of the Federal Reserve Bank of New York or the Federal Reserve System, or there is another one, or those of any other organizations. And I have to say that because I show you some charts, and those charts will use data that come from the Office of Financial Research. So, all right. So with that out of the way, so as you know, for 2 years, more than 2 years, 2.25 years here at the Fed, we have been reducing the size of the SOMA portfolio. And the FOMC has slowed the pace of shrinking of the portfolio back in June, and then said in his plan that he plans to stop reducing the portfolio, reducing the shrinking of the portfolio once reserves are somewhat above the ample level. And of course, it's very difficult, if not impossible, to judge ex ante with great confidence what the transition point between abundant and ample reserves is, because there are many factors that affect the reserves, and these factors change over time. And so I said it before, and I say it again, a better strategy, I think, is to let the market speak, and for us to monitor a variety of indicators embedded in market prices and quantities. And so maybe one natural place to start, an intuitive at least place to start, is to look at the spread between the effective federal funds rate and IORB, under the idea that as reserves shrink, naturally that spread should move up. And as you can see from this chart, for now, that spread has been rock solid, very stable, hasn't moved for a year, and ever since we started the shrinking of the portfolio, if it moved down by 1 basis point. So the spread has been extremely stable indeed, not just the spread, but the whole distribution of federal funds rate has been unmovable. So that's kind of one indication that maybe reserves still are very much abundant. But the point is that a stable effort to IORB spread is, it's not a guarantee that all is quiet in money markets, and indeed the spread could increase even if reserves remain range-bound, as I will try to explain. So in May, I gave another of these speeches, and I discussed a set of indicators that could help us get better visibility. And what I want to do today is want to take first a quick look what those indicators are telling us right now, and basically mark to market the message that these indicators are sending us. So first one that I want to talk about is the sensitivity of the funds rate to changes in the supply of reserves, or which you can also interpret as the slope of the demand curve at the point where the financial system is operating at the moment. Of course, this comes from work done here at the New York Fed by Gara Afonso, Domenico Giannone, Gabriele La Spada, and of course, last but not least, John Williams. So this indicator is not only statistically indistinguishable from zero, is actually the point estimate is pretty much zero. So what does it mean? It means that the slope of the demand curve for reserves at this moment is zero, so that the system is operating in the flat portion of the demand curve, which tells us that reserves are still very much abundant. Now, a second indicator is that I mentioned is the share of domestic banks borrowing in the federal funds market. So domestic banks tend to borrow in the funds market when they actually need liquidity. So an increase in the share of domestic borrowers in that market is indicative of reserves becoming less abundant. But as you can see from this chart, that share has actually remains very low, and if anything has diminished in recent months. So all is quiet in that dimension as well. So a third indicator is the timing of interbank payments during the day. So banks tend to tactically delay payments when reserves are tighter to prevent their account balances from getting too low. And so late payments correspond or correlate at least with tighter reserves. So same message, okay, so things that this indicator has increased maybe a touch, but as you can see, it remains pretty low, certainly with respect to where it was in 2018, 2019. So nothing exciting here either. And so one other indicator I want to mention is the amount of daylight overdrafts. And so daylight overdrafts occur when short-term shifts in payment activity results in the temporarily negative balance in a bank's reserve account. So higher average overdrafts are an indication that reserves are harder to come by in amounts needed to facilitate payments without intraday credit from the Federal Reserves. So while peak overdrafts activity has occasionally spiked, as a number of you have noted, and as press reports have noted as well, so peak activity has spiked on occasion, but average overdraft, which is plotted here, have remained very low and actually have declined in recent months, as you can see here. So why I draw the distinction between peak and average? Well, because average overdrafts are more useful for our purposes because we are interested in aggregate quantity of reserves, and so average overdrafts are much more informative because they abstract from idiosyncratic factors that affect individual institutions. So these indicators are, certainly not exhaustive. There are many other things that we're watching, right? But I think they're useful to monitor movements along the demand curve for reserves. And by that, I mean situations where reserves become progressively less abundant and eventually, as they approach the ample level, lead to a somewhat higher federal funds rate relative to the IRB. Imagine a movement along literally along the demand curve. We're starting from the flat portion. As the reserves shrink, eventually we'll reach the inflection point and we should see the funds rate start moving up slowly. So since the FOMC has said that it intends to stop balance sheet runoff when reserves reach a level somewhat above ample, these indicators can be helpful in informing the decision on when to stop the runoff process. But by looking at these 4 indicators that I just showed you, I think it's very hard to conclude anything else other than the reserve, that the reserve remain abundant at this point. So that's good. So far, so good. But there's always a but, right? So in addition to estimating the position where we are currently along the demand curve, I think we need to be alert to the possibility that the demand curve for reserve may actually shift. In particular, may shift up. So it may shift up and lead to an increase in the funds rate, even if the quantity of reserves doesn't change all that much. So there are several possible drivers of that process, and one that I want to focus here today in particular is the repo market. So in May, I showed you a 5th indicator, which is the share of repo trades that takes place at or above IRB, and but oops, see this guy has moved up pretty noticeably of late. So I like to think of the repo market as a mechanism to redistribute liquidity from those who have it in excess, for example, money market funds or GSEs, to those who actually need it, for example, dealers or levered investors. And so one obvious reason why repo rate demand may be going up why repo rates may be going up is the imbalance between demand and supply. So on the demand side, in recent years, obviously, as we know, Treasury issuance has increased materially. There has been no lack of demand for those securities, but many investors need to finance their purchases, and so more demand for repo financing. Of course, the shrinking of the SOMA portfolio contributes to that demand because it puts more securities that needs to be absorbed by private investors. Of course, also the shrink of the portfolio affects the supply of repo financing because it shrinks the total amount of liquidity in the system. So the evolution of demand and supply is one reason why we may see increase in repo rates, or added repo rate pressure. But I think there seems to be a second important reason that's worth talking about, which is frictions that may be interfering with the liquidity redistribution process. And one example of such frictions stems from increased concentration in the repo market, which has made it harder for some dealers and money market funds to increase their exposure to each other. In other words, repo supply can be limited by counterparty risk limits. And one place where this friction manifests itself is substantial balances remaining at the owner-RP facility. So despite the fact that repo rates have gone up. So most of our counterparties leave relatively small amounts on the owner-RP, but some large fund complexes still use the facility to a considerable extent. For sure, there are several reasons for that, but one may be that these complexes would like to access the higher repo rates in the repo market, but they may not be able to do it to a full extent because their counterparts may not be willing to deal with them in the amounts required because of the sheer size of this funds. And so, whatever the reason, liquidity left at the owner-RP does not flow into the repo market as smoothly as it did in the past, and therefore contributes to higher repo rates. So the good news is that the market can adapt to this situation. In particular, large money funds, for example, can increase the number of their counterparties, for example, by adding sponsors relationships in the centrally cleared part of the market. But as we all know, this is not an easy process. There are many legal, operational constraints, so this takes time. And in the meantime, repo rates may stay higher or even continue to increase. So one thing that high or higher repo rates can do is they can pull up the federal funds rate even if the quantity of reserves doesn't change all that much. And one way in which this can happen is via the federal home loan banks. So home loan banks lend in federal funds markets, as we know, but also they lend in repo and a variety of other markets. So if repo rates become persistently and sufficiently higher than federal funds rate, well, home loan banks may redirect an investment away from the lending away from the federal fund space and towards the repo space. So we know the federal home loan banks are the dominant lender in federal funds, about 90% of the market. And so if the home loan banks are lured towards the repo market, well, federal funds rates are going to go up. At the same time, the repo market is much larger than the funds market, and so the extra lending doesn't affect repo rates all that much. Net result is, of course, or could be, repo rate pressure that brings up the federal funds rate. Or put differently, higher repo rates could be the mechanism through which the reserve demand curve shifts upwards. So through this mechanism, we could see higher federal funds rate, even if the aggregate quantity of reserves remains range-bound, where it has been more or less ever since the runoff of the balance sheet started. So, but if the funds rate moves up and gets close enough to IORB, foreign banks, which are the largest borrowers in federal funds, primarily to earn the spread between EFR and IORB, may pull back from that market, and at that point, the size and structure of the federal funds market could change, leaving mostly rate-sensitive domestic banks as borrowers. So that could change, that could increase the federal funds rate volatility, while leading to a downward sloping demand curve for reserves and making the market more prone to hard-to-predict shocks. So for that reason, I believe that so if that happens, some of the indicators that I mentioned earlier probably start moving up. Will start joining the repo indicator that I show you in a higher direction. And for one natural one would be the share of domestic banks borrowing in the funds market. If the foreign banks go away, that indicator would move up automatically, but others may follow as well. So for now, I think the pressure in the repo market do not appear to be close to the point where they will start affecting the federal funds rate. We're seeing the beginning of some pressures, but I don't think we're at the point where the funds rate is about to start moving up, let alone moving up a lot. But, I believe there is plenty of room because of this for us to continue to shrink the Federal Reserve, the SOMA portfolio. Still, in the past, the repo market has arguably served as a leading indicator of pressures in reserves. There's no guarantee, of course, that it will do that again in the future, but certainly here on the desk and in other corners of the Federal Reserve System, we'll continue to watch that market. So to sum up, let me show you this chart, which is kind of a way to summarize the message that our 5 indicators are sending us at the moment. So this spider chart here. So points near the interior of the chart correspond to abundant reserve conditions, whereas points towards the exterior correspond with reserve becoming progressively less abundant and eventually scarce. So current values are near the interior and much lower than those seen in 2018 and 2019, as you can see there. And so that's good news. But again, if you look at the southwest corner, if you want, of the Pentagon, so the blue line, the blue Pentagon is the current one. So the southwest corner is extended much further out than the other corners, and that again tells us that the repo market has been moving and warrants monitoring. So we'll be monitoring, indeed, that's what we do. We'll be monitoring the repo markets and money market generally, both for early warning signs of shifting reserve conditions and risk of upward pressure to the federal funds rate, even if reserve conditions are stable. But in the meantime, SOMA portfolio runoff will continue, and as Chair Powell noted, that process is part of the normalization of the Federal Reserve policy stance, just like the 50 basis points reduction in the target range of the federal funds rate that the FOMC announced last week. So with that, let me thank again the staff for the joint member agencies. Thank you for participating in this, again, excellent conference up to this point. That's it. So I think I'll turn it over to Brian, who I believe, hopefully, is going to tell us that the reception is open downstairs.
I'm not going to dash your hopes just yet. You were right, that does conclude the conference events today. Thank you for everybody who is here in person and those watching the stream on the web. Before you go downstairs, I'm going to provide a friendly reminder to get all your stuff from your seat, the coat check. Before you leave this floor, if you leave something up here, you won't be able to freely come back up here, and that'll be a challenge that you don't want to deal with. If you are able to join us for a reception on the first floor, there is a self-check coat space down there for any things you need to bring down there. And with that, thank you and enjoy.